This is Bazaar Morning Call. Broadcasting live from the CNBC-TV18 Motilal Oswal studios in Mumbai.
Hello, welcome to Bazaar Morning Call. You're watching us live from the CNBC-TV18 Motilal Oswal studio. I'm Sonia. Joining me today, Mangalam and Nigel. Guys, markets have been slightly on the fence, right? Because broader markets have been under pressure. But today, global cues are not too bad.
Well, that's right. Global cues not too bad. And we're going to be halfway through the week. So pretty good. Let's see how things pan out then.
Let's see how things pan out. In fact, just before starting, we were talking about how phenomenal the new coastal road in Mumbai has been. One side of that has opened. The market gives me an analogy like that only. Those who are stuck outside the coastal road are perhaps in the mid caps and the small caps. The ones who've taken the coastal road
are cruising through.
Maybe through some of those large caps. The only problem, not many people on the coastal road yet. And that's a good thing, actually.
That's a good thing. But, I want to talk about the coastal road to you later on, maybe after the show.
Yes, most definitely.
But in the meantime, let's tell you what all is happening in the markets. The global cues were strong overnight. No two ways about that. The US markets bounced back. The S&P 500, in fact, closed at a fresh record high. You had the Dow that was up almost 235 points. So at least you have that part of the market which is stable. For our own markets, the broader market pain continues. So if you look at what's happened with the mid and small cap part of the market, there has been a lot of sectoral rotation out of small and mid caps into large caps. So if you just look at the Nifty Mid Cap 100 index, it was down 1.5% yesterday. The Nifty Small Cap index is down 6% in March so far. So that's the kind of pressure that we've already seen. But just to put that into perspective as well, the small cap index was the best performing index last year. So some amount of money is being taken off the table, which is, I think, par for the course. A couple of things to watch out for this morning. ITC will be top of mind after that $2 billion sale by its top shareholder, BAT. That suggests that there is some depth in the market. Of course, Mangalam will talk more about the sale in particular, but a couple of things to watch out for. One is that this is the third MNC this year to pair stake in an Indian arm. And the sheer size of the deal, A, shows you that there is a lot of appetite in the market, and B, that there is a lot of depth in the market. So that is a big positive from the market standpoint. In terms of macro data, you also have the inflation. I haven't mentioned that here because inflation data was very stable, pretty much what we saw last time around, an indication that, the macro environment continues to be quite stable. But Nigel, the worrying part really is what's happening in the broader markets. The sell-off over there, a lot of retail investors reaching out to say, what do I do with my portfolio now that things are a bit under pressure?
Well, that's right. Portfolios haven't been feeling too good. So let's, focus on the three big points that I'm looking at for today's trading session. One is the Nifty Bank. Well, it plays out a weekly expiry in today's session as well. So the Nifty Bank is going to be the one that will be in focus in today's trading session. Let's get that up for you on the screen. The Nifty Bank is going to be playing out weekly expiry. Next up, you have ITC. That's going to be the stock of the day probably, given its weight of close to around 4% approximately. And the other big question is, can the breadth of the market gradually improve from current levels? That's going to be the other big factor. In terms of a hygiene check, well, the FIs, they added close to around 7,500 long positions in yesterday's trading session. That compares with close to around 2,500. So that ratio is close to around 3:1. Currently, they're still net short with close to around 57% of their positions on the short side. ITC, it's going to be the stock of the day. Besides all the fundamentals, the last few days you've seen a surge in the open interest, and that's going to be on the short side. So in the month of January, for that series, the average open interest was close to around 8 crore shares. That's moved to close to around 11 crore shares. And yesterday, there were 35 lakh shares that were added in the F&O market, in the futures market. So those shorts will scramble for cover if in case that deal does take place in the block window. That's going to be an important point to note as well. The Nifty Bank, the important levels come up for you on the screen. That's the broad range you're looking at. And I say that because you have the yesterday's low that came in, closer to this level. And also the 50 DMA is closer to around the 46,600 odd marks. Those are the broad levels you should be looking at on the Nifty Bank. On the Nifty options data, well, put writing continues. 22,000 put, 20,050 put. Both of them did see a fair bit of open interest build up as well, which brings us to the level. Support level, 22,000 mark. That's important. On the upside, 22,550. So we're going to be in this 550 band. In the near term, if you want a reference point, the 20 DMA becomes important, which is closer to around 22,200 odd. Finally, the breadth of the market, you'd like it to improve. And I was looking at the NSE report card. They put this out at the end of the day with regard to advanced decline number of stocks moving either which ways. So you'd like that number of stocks that are advancing to go up to say 700-800 odd. You'll be feeling better about the market. So that's one data point that I'll be looking at. The second factor is you have way more stocks that are stuck at lower circuit. On the NSE itself, for yesterday's trading session, there were close to 400 stocks that were stuck at lower circuit, which means there's no exit out there. So that's going to be another important one that I'll be looking at in terms of data point, the number of stocks that are at lower circuit. So let's see how this goes. The breadth of the market could improve. The Nifty continues to remain in an uptrend as long as that 20,000, 22,000 odd mark holds out. And the Nifty bank plays out weekly expiry, which holds the key. But Mangalam, what about the global Qs? How are they stacked up?
Well, the global Qs are largely positive, and that's a good thing for our markets itself, because that's the one factor that could have played Trond had the inflation data come out much higher than what the street was anticipating. So what has happened this morning? Asian stocks have opened higher. There was a strong close on Wall Street. There was some consolidation over the last few trading sessions, but now yesterday the Wall Street indices have bounced back, and they've bounced back from important levels as well. The Nasdaq is now up around 1.5%. The S&P 500 has hit a record high. In the macro end, what could have caused a bit of fear was inflation. Inflation has come in at 0.4% month on month. The street was working with the same number. Year on year, it's 3.2%. Again, the street was working with a number of 3.1%. There has been a slight increase in US yields, but no change in the probability of a rate cut. For June is 70% probability that there could be the first rate cut out there. What will keep US investors happy is the fact that Nvidia has begun its up move once again. The last two trading sessions was down about 7%. Yesterday was up 7%, so has begun to move higher. You did speak about the FIs adding their long positions yesterday, right? From 40%, it's gone up to 43%. Nifty Bank is the one that we'll be watching out for because it's a Wednesday. Nifty Bank weekly options expiry. And for that, it'll be HDFC Bank, which will be extremely crucial to watch. Why is that? Because yesterday the stock did extremely well. And now there is some sort of support expected, largely because of the FTSE inflows, which will come in with effect from March 15th. So that keeps the stock higher. Yesterday it was up around 2.2%. The other heavyweight out there, we've been talking about it ad nauseum, ITC, a bunch of brokerage upgrades coming in too. My sense is that maybe it could be a block window deal today. And Infosys is the third one. IT stocks did well yesterday. Infosys is meeting investors at the Nomura US conference. Any positive commentary coming in from Infosys would keep these three heavyweights intact. And to add to that, we have Reliance, which is doing well as well. So those are four stocks which are keeping the frontline indices okay. The mid-caps are a bit of a problem.
Oh, the mid-caps are a big problem, actually. Not just mid-caps, the small caps, right? So this month, the Nifty is up 1.5%, but the BSE small cap index is down 5.5% this month. So yes, portfolios are getting affected for sure. But let's do one thing. Let's kickstart the show and tell you what's lined up. First up, we have some money market views coming in from Pankaj Chitlangia of First Basis, who says that following higher than expected US Feb inflation figures, the US 2-year yield is seen rising towards 4.6%, while the Indian 2-year yield has recently softened, giving rise to the possibility of a mild uptick in the dollar INR rates. He says chart indicators suggest that the US INR can remain above 82.70 levels and edge higher in a minor correction towards resistant levels of 82.95. He also says a breach of 82.95 levels would challenge holding a bearish dollar INR view.
And on the bonds, we have Neeraj Gambhir of Axis Bank saying that India bond yields fell during the week, tracking the decline in US treasuries. He said the 10-year benchmark bond yield almost touched about 7% post a net downward revision in the last 2 months US non-farm payrolls by about 1.67 lakh. He says US unemployment rate jumped to 3.9%, which is slightly higher than consensus of 3.7%. He adds that Jerome Powell struck a fine balance in his testimony to the Fed as well, reiterating wait-and-watch mode coming in for the inflation trajectory. Expects the 10-year benchmark bond yield to trade in a range between 6.95 to 7.05 this week, basis the crucial data that came in from India and the US CPI data too.
Well, we have a lot of stock-specific action tracked for you. We get to that in just a bit in our special Top 10 segment. For the time being, we run it through the list. We're looking at ITC, Shree Cement, Nidalon, Oro Pharma, Shalby. All of them will be reacting to positive news flow, while we also add to the list Signature Global, Muthoot Capital, Oriental Rail Infra, and Sterling and Wilson. The lone stock that will be reacting to negative news flow is likely to be Vedanta in today's session.
Okay, well, let's get our first guest on the show. Nathan Sheets, Global Chief Economist at Citi, joins us now to give us his view on the markets and how things are shaped up from here. Nathan, hi, good morning, and thanks a lot for joining in on the show. The markets so far have been fine. It, in fact, was a broad-based rally that we saw on Wall Street overnight. But how are you feeling about the remainder of this calendar year? Because risky assets like equities have done well up until now. Do you think now things are going to start getting a bit tough?
Well, as you say, the markets have been very, very aggressively priced. Let's put it that way. And even today, we saw that with these hot inflation data, and the S&P rising further. And I think the markets are, looking at the silver lining here. That these inflation data were hot. But they were not as hot as January and not as hot as maybe had been feared. And I think that's broadly the tone right now, where the markets are inclined to see the positive. And I think the underlying driver of that is market participants are looking forward to Fed rate cuts. And these data that we got on inflation will give the Fed pause, but it doesn't change the basic narrative. And we continue to expect, as do the markets and many others, that the Fed is going to cut in the middle of the year, and there will likely be a couple of rate cuts even beyond that. So I think that's the driver, and I think that that's likely to continue to support the markets for quite some time.
All right. Hi, Mr. Sheets. Good morning and good to see you in. So you're factoring in a rate cut in the middle of the year and a couple of that post that. But what about an emerging market like India? Equity valuations, they're trading at elevated levels, but earnings growth as well has been fairly good out here in India. Your view on the Indian markets, and how is this toss-up shaping between India, which is a relatively expensive market, but far more stable and has a good structural story, while China, the one that's bombed out, but there is hope that there could be some policy measures. Your take.
My sense is that we are at a point where global investors' sentiment toward India is very strong. The most positive that I can remember in my career. And I think that the underlying dynamic is twofold. First, investors are seeing strong growth performance in India and underlying structural reforms that are supporting the performance of the economy. And by the same token, I think that there is a bid for assets in places other than China for geopolitical reasons, for diversification reasons, for a variety of reasons. I think global investors are increasingly thinking about what are some other jurisdictions beyond China where I can invest. And I think India has been a beneficiary of that. Last week I was in Mexico. I think Mexico is a beneficiary of that. And I think given the geopolitical realities, that is likely to be a fairly durable source of demand for Indian assets for quite some time to come.
Well, Mr. Sheets, while the optimism for India is high, so is the price, because while on the one hand, everyone wants a slice of India, there are a lot of global companies, they're selling their slices of India, perhaps doing that valuation arbitrage. We've seen that in the very recent past as well. So what would your advice to clients be? Even as the optimism is high, what would their, entry strategy into India be at these prices? How should one deploy money?
I think the key is what you mentioned before. It's the key for the Indian market. It's the key for the U.S. market. And it really boils down to the durability of earnings. So when I think about valuations in global equity markets, and when I think about valuations in the Indian market, my guidance, my advice would be for investors to kick the tires on earnings projections and make sure they're comfortable with them. If we continue to have a solid global economy and solid earnings in the corporate sector, I think it's likely to support, the valuations, broadly speaking, that we see. But if those earnings falter, then I think we're likely to move into a different kind of regime, and some of the pricing that we see could be problematic.
Got it. Thanks a lot for joining in, though. I appreciate your time here on CNBC TV 18. Let's slip into a quick break on that note. On the other side, our list of top 10 stocks is lined up with our entire research team. Keep it with CNBC TV 18. Welcome back to Bazaar Morning Call. Straight to all the top stocks in focus this morning. Our research team is standing by to help you with the names. ITC, of course, after that big news flow overnight. But in case you missed it, Mangalam's here. Mangalam, over to you.
Well, the reason why ITC will be in focus today is because British American Tobacco, BAT, has launched the book to sell 3.5% stake in the company. The price band for sale is between 384 to 400 rupees per share, implying a maximum discount of up to 5% from the last close. One gets a sense that it would take place in the block window itself, and the deal, which is about a $3 billion block deal, will be the largest deal that we will see since 2019 itself. BAT stake post this will reduce from 29.03% to about 25.5%. And post this sale, there would be a 180-day lock-in for BAT to sell any further stake in ITC. Is BAT likely to sell more stake? Well, they had told analysts post their results that they won't reduce their stake below 25% in ITC. So that removes a potential supply overhang, and that explains why we saw a lot of brokerage upgrades coming in as well. Case in point, something like Morgan Stanley said that this will clear uncertainty around supply. The stock's outperformance will resume post the stake sale. They have a target price of 491. Remember, the stock is down 11% from the start of this year, as against other companies which are up by around 11 and 66% as well. That's VST Industries and Godfrey Phillips that I'm talking about. So ITC, post the large trade, opens in the green.
Okay, all right. Mangalam, thanks a lot for that. Well, I'm looking at three stocks. Let's start off with the first one. One is Vedanta. SEBI has ordered Vedanta to pay around 78 crore rupees to Kane UK Holdings for a delayed dividend payout. And Vedanta has said that obviously that SEBI's order will not have any material impact because the quantum is not too large. But given a rap on the knuckles from SEBI, expect that stock to react negatively. That's first one. Second one is Shree Cement. They've entered into an asset purchase agreement with an RMC manufacturer here in Mumbai for around 33.5 crore rupees. A small number this is, but it's a strategic location of RMC plants which will help them make some penetration into the key construction projects in MMR, which is a lucrative market. So that's one factor out there. And to recap, in the quarter one con call itself, they had mentioned that they're looking to foray into RMC, and that's what they have done. And also, indicated in their press release that they're going to be looking at increasing this RMC contribution. So expect the stock to react positively to this piece of news. Nidlon, that's the other one I'm looking at. Yesterday, there was a large trade that took place. The promoter sold close to 2.5% stake. And you have Mr. Nihar Nandanilekani. That's the son, I understand, of Mr. Nandanilekani, who's bought close to around 2.5%. So big name coming in there. Expect the stock to react favorably in today's trading session.
Okay, well, lots of stocks in focus. Ekta's joining in to give us details on Aurobindo Pharma and Shalby. Ekta, over to you.
Well, yes, for Aurobindo Pharma, the news is that Eugia Pharma Specialities has started the distribution of aseptic products which are manufactured at Unit 3. Remember, this Unit 3 was inspected in Feb and was issued 9 observations, and they had voluntarily stopped manufacturing from the facility because of the observations, and they had indicated they could see a $20 million impact on Q4 due to this. Now, the distribution of aseptic products manufactured at Unit 3, like I mentioned, was temporarily stopped. They expect commercial products of the aseptic lines to begin by April 15, 2024. So maybe there could be a little bit of green on Aurobindo on account of maybe commercial distribution starting from that particular plant itself. Shalby is going to be investing in Healers Hospital. It's an acquisition for around 104 crores, but it is for changing their business model of their Sanar International Hospital in Gurugram from a lease model to an own model. So that's basically consolidating their operations there. You can probably expect the stock to be a little in the green on account of this.
All right, Ekta, thanks a lot for that. So those are a bunch of stocks that we'll be watching out for from the pharmaceutical space. But Vamakshi joins in with a lot of other stocks that she's been watching out for this morning as well. Vamakshi.
Well, absolutely, Mangalam. Let's first start off with Signature Global. Expect the stock to open in the green after the company, through its subsidiary, has launched a new project under affordable housing policy in Gurugram. This project consists of nearly 235 units and is spread over a land of almost 1.6 acres. Muthoot Capital is the next one that we will be watching out for. Expect the stock to open in the green as well after EVFin has partnered with the company to expand its electric two-wheeler financing across India. And in fact, this collaboration entails a total deal size of up to 150 crores. Oriental Rail Infra will be the next one that I will be watching out for, and that is because Indian Railways has increased the order quantity of box central wagons by 91 wagons to 3,055 units. Earlier, back in May 22, they had received an order for 2,964 crores, and that was actually valued at 1,212 crores. And now with the additional 91 wagons, the order value has been revised by almost 37 crores. So expect the stock to open in the green on the back of this news flow. And lastly, we will be watching out for Sterling and Wilson. Yesterday, the stock was down nearly 5% after reports had emerged that stated Shapurji Palunji may sell stake in the company to manage their debt. But in fact, we saw clarification that came in from the company, and they have categorically denied this news piece. So definitely on the back of that, Sterling and Wilson expected to open in the green today.
Thanks a lot for that, Vamakshi. Well, here's a quick recap of all the top stocks we'll be looking at. Stocks with positive news flow: ITC, Shree Cement, Nidlon, Auto Pharma, Shalby, Signature Global, Muthoot Capital, Oriental Rail Infra, and Sterling and Wilson. While Vedanta will be reacting to that order coming in from SEBI.
Okay, all right. Well, there are some brokerages as well, some brokerage notes actually that one should be focusing on for the day. Sudarshan is here to give us the lowdown on that. Sudarshan, good morning.
Morning, Sonia. So in the brokerage corner today, first I have Jefferies on BSE. It has returned on BSE after NSE has announced a 1% cut to transaction charges on cash and derivative products. Jefferies has a buy rating and target is to be 3,000 per share. It says this cut is a part of periodic exercise by NSE and quantum is very small this time. And BSE's product pricing and monetization plan of new products will be unaffected by this. It continues to expect more than 2.5 times jump in earnings over FY24-26. CLSA has written on Jubilant Food after company has provided additional details for newly acquired business in Turkey and Bangladesh. CLSA is a sell call and target is rupees 439 per share. It says sales and like-for-like growth for Turkish is impressive, but overall profitability is impacted by debt. Also, there is a currency risk as cash flows in Lira and debt in euros. Last is Nomura on NBFCs. It reiterates cautious views. Shriram Finance and 5-Star Finance are top picks. It says growth is at risk and FY25 will be reset year for NBFCs. Cost of funds to remain elevated in FY25, and if rate cut happens in H1 FY25, it will be positive for cost of funds and net interest margin. Nomura has cut growth and net interest margin estimates across the coverage in the NBFC segment.
All right, Sudarshan, thanks a lot for that. So those are a bunch of stocks that one will watch out for on account of brokerage notes that have come in this morning. But let's also get in Manisha Gupta for a quick roundup of all the action coming in from the commodities market overnight. Manisha, macro data coming in from the US.
Oh, absolutely. And that really seems to have impacted commodities across board. I'll start with the crude oil prices, where the strong OPEC demand outlook for 2024 and 25 seems to be supporting the markets. Also, the U.S. inventories have taken a big hit, down by 5.5 million barrels in the previous week is supportive. And then talks of Israel and Hamas ceasefire falling through also have added some geopolitical premium to the prices. So while the crude is trading in the positive, can't say the same about the precious metal prices. Gold and silver both took a bit of a profit-taking, a knockdown. In any case, the prices had run up too much too soon. All-time highs were being created for every day in last 7 trading sessions. With the U.S. inflation data higher than estimated at 3.2% for the month of Feb, that has taken the gold prices down by $50 from its all-time highs. Some profit-taking is what we are seeing in silver, copper, zinc also trading slightly weak as the U.S. dollar index has gained. So most of the metals starting the Asian market slightly in the negative.
All right, thanks a lot for that. We'll take a short break. Up next, Devin Choksi of DR Choksi Finserv will join in for some fundamental stock analysis. Stay tuned for more.
Welcome back. Here tuned in to Bazaar Morning Call. Well, overnight the cues are fairly positive, and that's why we're bracing ourselves for a positive opening today. Well, let's get you some important macro data, though, that came in post-market hours yesterday. Inflation remained steady in February at just over 5%, even as food prices accelerated. Meanwhile, the core inflation cooled off to around 3.3%. Industrial output in January also remained steady at around 3.8%. Ritu Singh joins us to decode both those numbers for us. Ritu?
Well, retail inflation for the month of February broadly stable at 5.09% compared to 5.1% in January and close to the number that our poll threw up as well. This came on the back of broad-based moderation in prices barring food inflation, which remains a spot of bother. Food prices inched up over the previous month at 8.66% in February, and this increase was driven largely by a rise in meat and fish inflation. Vegetable prices as well remaining high as expected, seeing a very sharp price rise of 30.3% over the previous year. Cereals and milk prices also contributed to the pain points, but on the other hand, edible oils and fats, they brought down inflation to some extent. But the big positive surprise was the core inflation, that is ex of food and fuel, coming down to 3.37% in Feb from 3.6% in January, a more encouraging trend. But on the IIP front now, there was more of a mixed bag. The January IIP growth slowed down to 3.8% from the revised December number of 4.2%, also a tad below our poll. The year-on-year growth continued to be led by mining and electricity sectors, mining growing 5.9%, electricity 5.6%, but manufacturing, which has the highest weightage on the index, recording a moderate growth of 3.2%. Now, barring primary and consumer non-durable goods, all of the other segments in the used-based segment category, they recorded a higher year-on-year growth than the overall IIP number for the month. Consumer non-durables registered a contraction of 0.3% in January, which indicates a muted consumption demand, while consumer durable output jumped sharply to 10.9%, but this was largely because of a favorable base effect.
Thanks a lot for that, Ritu. So good to see that inflation's under control. Devin Chauksi, Managing Director at the Chauksi FinServ, joins us on the show. Hi, Devin. Well, the stock of the day is going to be ITC. Fresh short build-up is what we've seen. Massive open interest build-up, close to 11 crore shares in terms of open interest. And the stock is already down 20% from the peak. What's your view on it in today's trading session? It's going to maybe open up flattish or maybe a little bit lower, depending on where that block is done. But what's your view?
Hi, Nigel. Good morning. Well, I think this is what the street was expecting, that moment the sale transaction gets over, probably I think one would like to buy into the stock. As we read today, I think somewhere in 385-37 range, I think stock is likely to get traded. If this particular thing holds so, then in such situation, according to me, the buyers will probably start buying into the stock. Whatever maybe the short position one has created, quite possible that I think with this transaction getting completed, and the next transaction could possibly happen only after next 6 months. So between this, I would think that today the prices should stabilize with the sale transaction getting completed. In my viewpoint, other fundamentals remain absolutely strong for ITC. So I think one could possibly look at adding the stock into the portfolio.
All right, one should look at adding ITC on dips. But, Devin, in the broader markets, we've seen a fair amount of wealth erosion over the last couple of weeks, so to say, after a long spate of wealth creation. So among the stocks that have fallen in the last couple of weeks, is there anything that has now come to attractive levels for you?
Good morning, Mangalam. Well, I guess I think some of the mid-cap stocks have given up 10-15% kind of a gain. And some of the weaker ones have actually lost even more than that. So to a greater extent, I think this is the time when probably you would like to see some of the stocks coming to a correction level where it becomes attractive to buy. We believe that I think mid-cap story and remains intact as far as the growth in the business is concerned. Maybe these valuations were far more stretched, and that is where I think one could possibly ask for buying them at a corrected level, which we have always been advocating. I believe that in this fall, when the correction remains a little sharper, position offering becomes more acute, I would think that it would give an opportunity to buy. So individual stock specific action definitely would merit buy into the fall. So we look into some of the good quality companies, particularly in automobile ancillary space, where we see the possibility of next round of rally happening very strong going forward. So selectively, there are other companies also in the mid-cap space, and that is where probably one would like to see the price correction taking place.
Okay, so you're looking selectively at some stocks. I wanted your thoughts also on the real estate space, because, that has come back in a big way. There's so much happening. I mean, Mangalam was just telling us about how he went on the Coastal Road project, right? And it was a brilliant experience. So connectivity is definitely improving in Mumbai across the board. But do you think all of this is in the price now, or is there more to go in real estate?
Well, I think, Sonia, good morning. I guess I think the long-term prospects of the real estate, I think definitely remains absolutely very, very strong. I think there is no question asked. In fact, if you ask me, I think next 50 years, I think Mumbai is going to be under reconstruction. So frankly speaking, I think we are going to see the real estate companies continuously doing well going forward as well. In the near term, I would like to believe that I think some of the companies, particularly those catering to the metro markets like Mumbai, I think have really actually scaled up on valuation. And that's where I would remain a little bit more watchful. One would like to buy the stock when the market gives you corrected price, I think gives you an opportunity to buy into. At this point of time, to me, I think most of the real estate companies are discounting FY26 already now. So there is hardly headroom left. I think one would like to buy when 15-20% kind of a correction takes place in the market, if at all. That would be the time to buy into these stocks.
All right, Devin, just hang in there because we'll discuss the IT space now. It's holding on to gains this week. In fact, Nifty IT is the only sectoral index gainer this week, being led by a lot of these large weights like TCS and Infosys. Apurva Prasad, who's a research analyst, IT sector at HDFC Securities, joins us now. Apurva, good morning. IT sector's been holding up after a long spate of underperformance. US as well is all about chips and artificial intelligence. In light of all of this, what are your views on the Indian IT stocks and what looks good?
Good morning. Thanks for having me. So, yes, they've been holding up fairly well. In fact, valuations have run up considering the fact that there is an anticipation of the growth trajectory to accelerate or rather bottom out, so both margins and growth. And then the fact that US macros have held up stronger than anticipated. So I think that's also causing this. But I think as value migration happens from the big seven, the remainder of S&P 500 on generative AI, I think the role of Indian IT companies increases dramatically. So I think that's what is creating opportunities. But in any case, the trajectory or the gradient of improvement is only going to be a very gradual one. So we do expect the normalization of growth rates for the sector over the next 3 to 4 quarters. Having said that, there's also scope for margins to recover. So that's essentially what we're looking at. We remain selective out here because valuations are constraining more positive stuff.
Apurva, hi, good morning. I want your thoughts particularly on TCS because the stock hit a fresh record high yesterday. It's been very strong. You have an ad on that stock. Tell us a little bit about what the triggers could be from here on.
So the triggers are certainly around some of the mega deals. So the BSNL deal, for example, gives relatively high growth visibility for TCS for next year. At the same time, in the current environment, I think the company with its execution track record has got a good chance of improving its margin. They have been actually outperforming on that for the past few quarters. So I think from an execution standpoint, from the current environment where deals are more cost-centric, cost optimization, there's a lot more vendor consolidation, captive takeover type deals. I think those support TCS. So I think the outperformance relative to Infosys could continue on growth also even the next year. That's what we're building in.
Okay, hi Apurva, good morning. Nigel on this side and good to see you in. You know, Wipro has been the stock that suddenly woke up in the last 1 year. I think it's given a 30% return or thereabouts and surprised everyone. You're not too bullish on prospects post this run? Tell us why.
We still have a reduce on Wipro and Tech Mahindra. I think the underperformance on growth as well as the margin catch-up is going to be a tough ask. They need to get to industry averages, growth averages. Look, the fact that there is a relatively large discretionary part in their current portfolio, the fact that they've got impacted on the BFSI a lot more than some of the peers. These are factors which could delay the recovery of the company. So on a relative basis, it's expected to underperform. And the ask becomes significantly higher at the current valuations. That's why we maintain our reduce on it.
Anything particular that you like in the mid-cap end of things?
Yes. So persistent systems have been liking that for quite some time now. I think that continues to deliver well. I think the good filter to have for mid-caps is companies which are on the top end in terms of magnitude of growth. Two, where there is relatively high near-term growth visibility and some possibility of upside risk to estimate. So I think Persistent Systems sort of fits there. I think they could be potential big beneficiaries of generative AI getting bigger. At the same time, there is also a margin upside case to that. So Persistent Systems and Birlasoft would be two companies within the mid-tier space that we continue to like.
Interesting. Okay. All right. Apurva, I also wanted to ask you your view on these ER&D companies. They ran up big time. Valuations no longer cheap. But what's the view out there? KPIT, Tata Elxsi, is there a preference between them?
Yes, so I mean, you could also actually bucket Persistent Systems in that category. So I think that would be probably the most attractive still in that expanded segment. Cyient on a valuation standpoint would still be more attractive, but Tata Elxsi and LTTS valuation constraints are the factors why we're not constructive.
Okay, that's interesting. So on Tata Elxsi, can you just expand that thought? Valuations are not attractive, you said, because the high that Tata Elxsi hit was 9,000 way back in December, and since then it's come off quite a bit. It's now at 7,500. So for an investor who perhaps has a long-term view in mind, is this a good time to be buying a name like Tata Elxsi?
Yes, actually, I mean, if I sort of zoom out, I think we've seen the full circle, because it used to be a topic at one point of time, and then we've been sellers since ever since it reached 7,000 or so. No, so I think the challenge is going to be that 40% of their business is around media and broadcasting, which is industry-wide. There are some challenges there. There are some client-specific challenges also in those sub-segments, and a piece of the business which tends to be volatile historically. I mean, the big run-up that you saw of the companies is also the case of margins that expanded from 21% to almost 30%, and that's what led to phenomenal growth in earnings. So I think the earnings growth is going to be more a function of top-line growth, and with that kind of a trajectory, valuations at 50 times FY25 is quite a stretch.
Right. Apurva, I'm not sure whether you cover LTIMindtree or not. It's been a rank underperformer in the space. A lot of people believe that, integration issues led to this underperformance, but a lot of them also believe that now it's in the price. Would you have a view there?
Yeah, Mangalam. So, yes, we are actually constructive. We have an ad rating on LTIMindtree. I think it's corrected a fair bit since the last quarter or so. There have been earnings cut to out here. But I think at 5,200, the risk reward seems to be quite favorable. While it may not have near-term positive catalysts with some of the integration-related factors that continues, and the fact that H2 tends to be stronger for LTIMindtree, which is not the case this time around. So therefore, the build-up needs to be a lot more for as they progress towards FY25. Having said that, at 5,200, it's at a substantial discount to TCS valuation. They were at good premium in the past. So I think these would be attractive levels to look at LTIMindtree.
Okay, these are attractive levels to look at LTIMindtree. Got it. Thanks a lot for joining in. Appreciate your thoughts here on CNBC-TV18. That's Apurva Prasad on the IT space. But getting back to Deven Choksi, who's still with us. Deven, your thoughts on IT? Because, clearly, as we were saying, right, I mean, something like a Tata Elxsi has gone from 9,000 to 7,500. So for someone who's perhaps looking at it with a long-term time horizon, not a bad option. But your thoughts, what would you advise investors to do?
Yes, Sonia. I think we continue to likes of Tata Elxsi, even Cyient Technology, and LTTS. I think these are some of the companies where we believe that I think they offer the unique proposition as far as I think their business deliverables are concerned in different verticals. So from that perspective, we see the visibility of at least around 3 years and plus, I think, from each of these companies as far as their order book and execution is concerned. Some of the companies may have scaled up on valuations like Tata Elxsi little early, little ahead of time. But I believe that the price correction has already happened. So maybe another 3 to 6 months of, I think, sideways movement in this particular stock at all. I would think that I think it would be a good opportunity to buy into. If market gives sharper correction, I think it would be a good opportunity to buy into, I think, these 2-3 companies where we believe that the fundamentals are really shaping up well and these companies are growing big in size.
Okay, all right, Deven, thanks a lot for that. Request you to stay with us. We have a few more stocks that we want to discuss. But for the time being, Anuj joins us to give us how he's viewing trade setup today. Morning, Anuj.
Morning. Well, you know what? I'll start with what's happening in the small cap space. That's something that I've been covering for last 1 month or so. Very interestingly, ICICI Pru has stopped lump sum investment into mid and small caps. Now, it's the fourth fund to stop it into the small caps, but the first to do it for the mid caps as well. So that's quite interesting because there's a strong debate within the mutual fund community on whether this should be the way to go, because at the end of the day, retail gives you money and it's your job to manage risk. Of course, the fund manager can always say that there's not enough quantity available right now to deploy that kind of money. So it's a bit of a debate out there. Now, my view is that the current fall in small caps and mini caps and SME stocks may not be the end of it. And there could be more decline in especially some of the poor quality stocks. But the froth in the good quality mid caps, because even in the good quality mid caps, there was a lot of froth. Froth in the good quality mid caps may be coming to an end, may be cleaned out already, and you will start to see that differentiation from here on, that some select mid caps will start to outperform from here on. The stock of the day today, of course, is going to be ITC. The block deal getting confirmed, a 3.5% stake. The big question is whether it will happen in window or outside. My channel sources are suggesting that it will happen in the block window itself. And if that is the case, then the stock could surge today because it's corrected sharply in anticipation of that block deal. And it's a bit of a coincidence, right, that 3 brokerages have upgraded the stock today with aggressive price targets, HSBC, Morgan Stanley, and CLSA. So if that happens, Nifty perhaps could take a bit of a lead over the Bank Nifty today, also because there's weekly options expiry in Bank Nifty today. On the Nifty, it respected the positional support of 22224. Yesterday's low was 22256, and the 20-day exponential moving average is 22190. Normally, in an uptrend, the 20-day exponential moving average is protected. So let's see if that's the case again. On the upside, the resistance would come at 22,452, yesterday's high, and then the all-time high of 22,526. And the Bank Nifty's weekly expiry today, yesterday's Spin Nifty expiry was very violent. I think it really punished traders a lot yesterday on both sides. And the Bank Nifty range is very large, 46,800 to 47,800. I mean, if you can trade that range, good luck to you. Otherwise, perhaps you want to just avoid it for the day and then take a fresh view tomorrow.
Okay, thanks a lot, Anuj. Very important perspective on the broader markets as well as on a name like ITC. But Devendra Choksi is still with us. Devendra, come in on the point that Anuj was making about, the kind of sell-off that we've already seen in the mid and small caps, and perhaps there could be more to go. I mean, the small cap index is down already 6% this month. Do you see, okay, by the way, the breaking news now that the ITC block deal was done in the block window, I think something that was expected. So that has finally come through.
That has finally come through, and this also tells you about, the kind of demand that was there for the paper itself, because it was launched at up to a maximum 5% discount to yesterday's closing price. Usually in the block window, if there is a deal which is done, it has to be done at a price difference not more than 1% of the previous close price. So the fact that it has happened in the block window implies that the price could be anywhere between 399 to 400 rupees per share, which is a lot higher than what was earlier offered as in terms of a maximum discount. So the range was 384 to 400. So the deal has happened at the higher end of that range, and it is not small supply. It's nearly $3 billion, which is the highest large trade that we've seen in the last 3 years or so. So the fact that it has happened in block window, there has been a lot of appetite. And the other thing is that not a lot of foreign investors would perhaps be participants in this because of the ESG factors and the fact that there can't be a lot more FDI in tobacco anymore. So a lot of it could also go to domestic institutional investors. Talks about the kind of appetite there is. Absolutely. And also, let's see how the stock reacts post this. The fact that this has happened in the block window would leave a lot of those shorts scampering for cover.
Oh, absolutely. And there are 3 brokerage upgrades on ITC this morning. We'll talk more about that later. Coming in from HSBC, from Morgan Stanley, etc. All of that in a bit. We'll take a quick break. We also have a complete market to trade. So Mitesh Thakkar and Sudarshan Sukhani will join in for some technical trades in just a bit. Stay tuned.
Welcome back. You're watching us here on Bazaar Morning Call. The breaking news this morning has been the news of the last few days. The block deal of ITC has been executed. As our ticker team tells us, the deal, the entire 3.5% stake by BAT has been sold in the block window itself, a near $3 billion deal that has taken place. the stock has been an underperformer from the start of this year, down about 12.5%, and its valuation premium vis-a-vis other tobacco players had also narrowed because of this underperformance, this supply overhang which was there itself. And this coincides with a lot of brokerage upgrades coming in as well. So this morning we've had 3 upgrades. HSBC has upgraded ITC to buy. They have a target price of 480 rupees per share. CLSA has upgraded. Their target price is close to around 468 rupees per share as well. All of them saying essentially the same thing, that this correction offers an attractive multiple in a volatile market because the supply overhang is now done with. Bad stake, which was a little over 29%, now comes down to a little over 25%, 25.5%. And this leaves them with a 180-day window to not sell further as well. And in any case, the question is, will they sell any more than they have sold already? Because they had told the analysts that, they will not sell, or they would like to keep their stake in ITC at around that 25% mark itself. The reason why everyone is bullish on ITC after this underperformance is, one, moderate cigarette tax environment. Because over the last 3 years or so, the cigarette taxes have not grown exponentially or in a way that would hurt the legal cigarette industry, and as a result of which the legal industry, tobacco industry, has gained market share from the illegal players as well. And secondly, for ITC itself, the non-cigarette businesses have scaled up too. So we've seen the FMCG business be among the largest revenue contributors for the company, and the margins out there are improving as well. So will this stake sale overhang provide an entry opportunity? Brokerages believe so. Let's see where they go.
How are the valuations looking now after the kind of underperformance that we've seen in ITC over the last 6 months?
So at the start of the year, the ITC stock was trading at around 26, 27 times, as against, say, something like a Godfrey Phillips, which was around 11 to 12 times, and VST Industries, which was around 13 times. Now, this year so far, ITC is down 12.5%, Godfrey Phillips is up 66%, and VST Industries is up around 11%. So the valuation gap has narrowed. ITC now trades at 21 times 1 year forward earnings. VST Industries is close to 16 times, and Godfrey is around 19 times. So that valuation discount, or rather premium, has narrowed. That makes it a lot more attractive from 26 times as against 21 times because of this underperformance, which is largely on account of the supply overhang itself.
Okay, all right. Mangalam, just one more quick word. That open interest had gone up to around 11 crores odd. Since it's happened in the block window, and yesterday there were 35 lakh shares that got added on the short side. They're going to be sprinting for cover in today's trading session. The hope was that for those short sellers or those that shorted the stock was that it will happen in normal duration and you'll get a discount, and that's how you'll be able to cover your position. Now it's going to be dangerous.
It's going to be dangerous, and what will also be interesting is that there was a lot of option activity taking place at the 4:30 call and the 4:50 call. And that's telling you that some people were perhaps positioning themselves for something like this to happen as well. Even if that does not happen, it will be very interesting to see whether the stock does go past that 4:30 mark in today's trading session as well. And even if that happens, 30 rupees on a 400 rupee stock is nearly 7 to 8%, which on the weight of ITC could actually power Nifty ahead.
Okay, well, most brokerages and the market expecting the stock to move up today as the supply overhang is out of the way. And of course, the valuations are quite attractive compared to what we've seen earlier. So let's do one thing. Let's take a quick break. On the other side of the break, we'll continue our discussion on ITC. We'll also have Mitesh Thakkar and Sudarshan Sukhani joining in for some technical trades. Amnish Agarwal of Prabhudas Leeladhar will also be joining in to discuss how to approach ITC now after that large stake sale has taken place. Welcome back. We have just a couple of minutes before the market opens and the pre-opening rates kick in. And for now, the Gift Nifty is suggesting a positive opening. Mitesh Thakkar and Sudarshan Sukhani join us now to tell us how to approach things. Mitesh, let me start with you. First, on the overall market, looks like the opening will be positive. But what do you do? Because there's been a lot of pressure in the broader markets. How do you deal with that today?
Good morning. So, my sense is that while the large caps have kind of managed to hold the Nifty, I think there is clear signs of distribution and pullback happening on the mid cap and the small cap side. So I think that movement is expected to continue. What I'm worried about if the large caps also start coming under pressure. Now the level to watch for that on the index is roughly about 22,250. If we have an hourly close below that, then I think we might see 21,950 and even 21,800, and you will see some damage in the large caps as well, and that will lead to slightly stronger selling in the mid cap and the small cap segment. So I think we've been advising, exiting and reducing the long exposure, be in more of wait and watch mode, see how the market pans out. But a break below 22,250, I think, would invite shorting some positions in the index via either selling call options or even buying put options.
All right. Sudarshan, your thoughts on the index?
Yeah, good morning. See, the Nifty is choppy, and that choppiness is leading to some uncertainty, but the trend still remains up. I mean, the markets can go choppy for a long period of time. That doesn't change the intermediate trend. So the trade in the Nifty is look for sharp dips, but you have a clear and visible stop loss, 22,200. That's not far away. So intraday dips should be bought with this stop loss in place. The Bank Nifty had a very choppy market movement yesterday, but that does tell us that the lows were held finally. So the Bank Nifty has a similar buying opportunity with a stop under 47,000. I would be a buyer till these levels are not broken.
Okay, all right. Sudarshan, why don't you go ahead and tell us your stock picks?
Sure. AU Bank is an intraday short. The stock is in a bear market, at least so far. Sell with a stop above 587. On the other hand, HDFC Bank has been building a base for some time now, almost 2 months. That's a very attractive chart, suggesting that an imminent uptrend is in the offing, which is why I have also not been bearish on the Bank Nifty today. HDFC Bank is a buy with a stop under 1430. Infosys has come down to a minor support level. Maybe it will hold. Buy with a stop under 1590. And finally, that very large cap Reliance has come down to another minor support level. It's anybody's guess whether it holds or not, but it's worth buying into with a stop under 29.25.
Okay, and Mitesh, what about you? What would your stock ideas be?
I have a mix of buys and sells as well. IT, I think, looks to be better placed space in the short term. So TCS on a 10-15 point dip, if you get it, say around 41.80, 41.70. Buy with a stop below 41.45 for targets of 42.50. LTI Mindtree is a buy with a stop at 5.65 for targets of 5,300. And then on the sell side is Ashok Leyland. Selling should be done with a stop at about or just about 171 for a target of 158. And Balrampur Chini is a sell with a stop at 371 for targets of 345.
Okay, all right. Thanks a lot for that, gentlemen. Well, let's get in Rajesh Palvia, Vice President, Technical and Derivative Research at Axis Securities, who joins us on the show. Hi, Rajesh. Good morning. What strategies do you have for us?
Good morning, Nigel. So market is choppy, and looking at the data setup, we believe that Nifty is likely to remain in range of 22,200 to 22,500 for some more couple of trading session. Looking at the call concentration, that is at around 22,400, 22,500. That strikes are attracting more call writing activity. So these levels are likely to act as a supply zone for any kind of minor pullback action if we get in the market. On the downside, the major put base concentration is placed at around 22,200 level. We believe that for some couple of trading session, Nifty is likely to remain in range only. So to play this range bound behavior of Nifty, we are initiating here short strangle strategy. In this strategy, we will sell a 22,450 call option, which was closed at around 68 rupees. And on the other hand, we will sell 22,200 put option, was closed at around 39 rupees. So almost we are pocketing around 110 rupees as an inflow of premium, and we'll keep a stop loss of 145 to initiate this short strangle strategy. So to play this range bound behavior of market, short strangle strategy may give some profit in next 1 or 2 trading session towards this 14th March weekly option expiry of Nifty. So once this premium shrink to 60-65 rupees, one can look to book profit also. Bank Nifty is still struggling to cross its major supply zone of 47,500, 47,700. That's the major call concentration area for this weekly expiry. So until the Bank Nifty not manages to cross above 47,700, some pressure is likely to be there in Bank Nifty also. On the downside, 47,100 is the key level to watch for in today's session. If he breaks those levels, then further more supply pressure we can see. On the stocks front, mix buy and sell, both ideas are there. On the long side, Balakrishna Industries is looking promising. in previous session, short covering was there. Stock already formed a base of last 7-8 days. Consolidation breakout is already there. So looking at the near term setup, we expect Balakrishna Industry can continue further more upside towards 3400. So one can look to buy this stock with stop loss of 2400 is the immediate target where we are expecting. One can buy with stop loss of 2325. The second stock which we like to buy is Bharti Airtel. Very stable price behavior despite of volatility in market. Stock is almost trading near to all-time high trajectory. So we expect Bharti Airtel can exhibit a good amount of rally in coming trading sessions. So 1240, 1250 is the target where we are expecting. Keep stop loss of 1185. The third stock that is on the short side, that is from real estate space, Godrej Property. One can go short in this stock. Stock broke its 20-day moving average and short built up was there. So Godrej Property, one can go short with stop loss of 2360. Downside target we are projecting towards 2280.
All right. Thanks a lot for that, Rajesh. Those are your stock calls, and the index pre-open has more or less settled for the Nifty up 116 points, but the important part is ITC. It's up 9% in pre-open. Briefly went to that 9.99% mark as well, temporary freeze that is. This is on the back of the large trade that has taken place in the bulk window. 7% gain now, around 435 rupees is where the stock is settling. Amnish Agarwal, who's the head of research at Prabhudas Leeladhar, joins in now. Amnish, a big move on ITC is what we're seeing after a lot of underperformance. Do you view this sale of BAT as an important supply overhang gone, and maybe the outperformance of ITC begins from here on? Is that your view?
Yeah, absolutely. Mangalam, if you see the past couple of months, ever since there was news that BAT is likely to reduce the stake, the stock, I think it peaked around, you can say, when the hotel demerger got announced and got consummated. And gradually, post-BAT, I think there was sharp fall in the stock price to around, say, 400 levels or so. Fundamentally, nothing changes in ITC. It has been a professionally run company from at least 3 decades, which I can recall. And operational side, there is no change. That is one. On the other hand, I think ITC on the business front continues to look good. And with this major overhang now over, I think the stock has the potential to, you can say, move up. Because if you look at the price band of 385, 400, which was being talked about, at 400, the stock is trading at just around, say, 14 times. If I just look at the cigarette business and you can say make adjustment or SOTP, which is more or less in line with where most of the other global tobacco majors are trading at, whereas India today is a much better market in terms of growth and output.
So, what do you do from here on in terms of an upside? See, because it's already showcasing a 9% up move, right? I understand that valuations are looking attractive, etc. But now that the supply overhang is out of the way, just help us understand, A, on a valuation perspective, post this 9% up move, what are your thoughts? And what is the fundamental upside that you're looking at business-wise?
Okay, you see, if you look at, say, business-wise, we have seen perhaps the best growth in cigarette business in the last couple of years. Now, on a steady-state basis, one can look at, say, maybe 3 to 5% volume growth and maybe high single-digit kind of a profit growth from cigarette business. The key driver for ITC is going to be first FMCG business, where they have seen a very steady increase in both sales as well as margins over the year. And I still believe that over the next few years, we will see further improvement in profitability in the FMCG business. Because if I look at, say, SOTP, FMCG business today is roughly around, say, 22% of our target price. The second one, which today is relatively smaller but has a lot of potential, is IT services, because IT services today might be, say, roughly around 2 to 3% of their overall SOTP. But over the next 5 to 10 years, I think IT services, given the kind of growth which Indian companies have from other big conglomerates, along with FMCG, it could be the major growth driver. Now, coming to, I would say, the stock price looking after the recent up move, see, we are valuing the stock at around, say, 490 is our target price, which is based on, you can say, December 23, and whereby we are valuing the cigarette business on 22 times. So I think even if you presume the worst of the you can say even if you presume a little bit lower multiple than 450, 460 is the price, So over the next 1 year, I think given this overhang now being over, and if we see, you can say 3 to 5% kind of a cigarette volume growth, the stock has got the potential to even give, say, another 10-12% return from here over the next 6 months.
Right, another 10-12% despite this up move that you're seeing over the next 6 months on ITC, your fundamental target price close to around 490 rupees, which is pretty much in line with all the others as well, which is closer to anywhere between 468 all the way up to 510 in the brokerage target price ranges itself. But what's also interesting is, over the last few quarters, Godfrey Phillips' volume growth has been a lot higher than ITC and VST Industries. Even in the last quarter, for instance, ITC's volumes were down around 1% of the cigarette business. Godfrey showed a growth of around 10.6%. Brokerages do believe that, the performance that they've shown in some of their newer brands has led them to gain some market share. And that's reflected in the kind of stock price move that we've seen as well. This year so far, Godfrey is up almost 70%. Amnish, would you look at other tobacco players as well or stick with ITC?
Okay, you see, as far as Godfrey is concerned, Godfrey's market share is significantly lower, and so there exists a lot of scope to increase the market share and grow the volumes. But having said that, ITC, one needs to look at it more as a conglomerate, because today cigarettes are only 57% of value. So if you are looking at a company which is a conglomerate, which has got presence in cigarettes with strong market leadership, with around say 80% market share, 77 to 80%, I would say the fastest growing perhaps the FMCG company among the companies which have been set up, say, at least in the last 2 decades or so. And you can say leadership in your paper and paper boards, thriving agribusiness, and you can say your then IT services, where they are slowly getting into act in the last 2-3 years in particular. I think ITC is a much broader play in comparison to Godfrey. But you can say the companies like Godfrey, which are, you can say, single product centric companies in single product categories predominantly. So there the growth rates can usually be higher because their market share is also on the lower side. But having said that, both the companies actually, you can't, it's very difficult for me to compare because ITC is a large cap, well-owned stock, whereas the other ones are more like ideas.
All right, Amnish, thanks a lot for joining in. By the way, it's going to be a big one today, right? ITC up almost about 9-odd%. The supply overhang out of the way. Valuations attractive. 3 brokerages have upgraded the stock this morning. So it looks like the going is going to be good. Well, let's get to some 9-10 calls now. First, in pre-opening, just wanted to point out that looks like the Nifty is going to be going to surge today. About 100 points pre-opening rates is what it's indicating. Of course, ITC will be front and center. But apart from that as well, you have other FMCG names. There's Britannia that's looking pretty good. There's a couple of other names from the IT space. So TCS hit a fresh record high yesterday. It looks like it could put on some more weight today. Apollo Hospitals, SBI Life, are a couple of other names. But let's get some 9-10 calls going now. Mitesh, what would be your big call for the day?
Yeah. I'll go with the buy on TCS, which is top below 41.45 for a first target of 42.50.
Okay. All right. Sudarshan, what about you?
Consider buying HDFC Bank with a stop under 1430.
Okay. Let's talk about some stocks that are on our Momentumizer list now. Vivek is joining in with today's Momentumizer of the day. Vivek, over to you.
Well, good morning. The stock that's on our radar today, that's caught our attention on the back of the fact that despite it being a very weak market, especially in the broader end for the last couple of trading sessions, one stock that stood out is actually Poonawalla Fincorp. Now, this particular stock, even in the last 2 trading sessions has managed to gain, and each day has seen individual gains of close to 4% each. So, stock up almost 9% in the last 2 trading sessions. Yesterday, the stock managed to claw up above the 50 DMA, and now, the stock is comfortably above the 50, 100 as well as the 200 DMA. When you're talking about, how the stock has performed in the last 1 year, the stock has gained almost 65% in just the last year. Let's reiterate, what the management has given as part of its guidance, in the investor presentation. Number 1, company in 2025 aims to be amongst the top 3 NBFCs in the consumer as well as the MSME segment. The company also aims to go ahead and triple its FY21 AUM, and in fact at the end of Q3 FY24 the AUM was almost 2.1 times FY21 AUM. So company is on track to go ahead and triple its AUM at the end of FY25. And also in terms of AUM growth, the company's long-term guidance is almost 30 to 40% growth. On the back of that, the stock very strong price action in the last couple of trading sessions. It's part of the Momentumizer list.
All right, that's part of the Momentumizer list, but all the momentum today definitely belongs to ITC itself. I was just doing some quick math, the stock up almost 9% in pre-open, and if that's where it opens up, it adds close to around 50,000 crores in market cap. What's interesting is that Britannia's market cap itself is around 110,000 crores. We have Godrej Consumer, which is 120,000 crores. So in a one-day move, ITC's addition to the market cap would be equivalent to adding half of Britannia or half of Godrej Consumer. Or Marico for that matter, close to around 65,000 crore market cap. So that's the power of the weight that, ITC has on the FMCG space.
Just 1 point on the Nifty opening. It's a 100-point opening. What's going to drive the markets for the rest of the day is the Nifty Bank, because that's up less than 40-50 points, I think. So it has weekly expiry. Good start, but what will help us build on from here has to be the Nifty Bank, because in pre-opening, that's doing a relative underperformance.
Also, it's interesting, right, how the Nifty is holding up very strong, especially large caps, not just ITC now, but if you look at the last couple of days, Tata Steel, by the way, this month is up almost 10%. Tata Motors continues to trend above the 1,000 rupee mark. So a lot of participation from large caps. But the mid caps and small cap space is where the pressure lies. So it's a sort of a dichotomy in the market right now, where on one hand, the large caps are holding very well, participation coming in from names like TCS, etc. But in the mid-cap end of trade is where you're feeling the pressure. But two macro cues, in case you missed out on them. One is that the global cues are very strong overnight. So you had the Dow, which was up 230 points, S&P 500 closing at a new record high. So that part of the market is pretty stable. And the other one is that the retail inflation data has been stable compared to what we've seen last month around. Despite that, actually food prices have gone up. But despite food prices rising, retail inflation overall has been very, very steady. So, well, here's the first take on the index. A strong opening as suggested. The Nifty is up almost about 80 odd points. The sensex is up about 300 points. So good opening, decent opening, you'd have to say. The mid-cap index really is the one that's up almost just about flat. And let's see how that one goes.
Well, that's right. In terms of stocks that are moving around from the broader markets, a few of them should come up for you on the screen. C Enterprises, that's opened up with gains of close to around 1% or thereabouts. You have a couple of other notable movers as well. I'm looking at the broader markets, actually. A few stocks that are moving on rather large volumes. Just want to pull some of them up for you on the screen. Let's get in a few of them. You have ITC, obviously that's the top mover out there. You have South Indian Bank, that's up close to around 2%. On the downside, a few stocks that are seeing a lot of selling pressure. Tourism Finance, big volumes, big underperformers, been getting smacked in the last few days. So keep an eye out on that one. Suzlon, we saw some kind of bottom fishing in yesterday's trading session. But that one again is down on very large volume. But Sonia's gone across to the wall. Sonia, tell us more.
So, you were talking about some of these broader market stocks. I thought I'll take it to the large caps as well. So ITC, let's see how that one's looking this morning. The big overhang is now out of the way. Brokerage upgrades have come through post that stake sale. So 5.5% higher on ITC, 427 on that stock. Cipla is also in focus. That stock has been having a very strong run lately. Now the company has got the US FDA tentative nod for a hypertension drug. So keep an eye out on Cipla, up 0.5%. You were talking about Shree Cement as well. That company will be buying 5 ready-mix cement concrete plants in Mumbai for 33 crores. So some corporate action over there. Aurobindo Pharma, UGI Pharma has started distribution of aseptic products manufactured at Unit 3. So Aurobindo Pharma is up 2% at the moment. Glenmark in focus as Nirma has completed acquisition of 75% stake in Glenmark Life. Titagarh has been in focus for the last many days after bagging a lot of orders. Once again, it's launched a second 25-ton pull tug for the Indian Navy. So some, positive news flow over there. But the stock is seeing a little bit of profit taking. Macrotech is in focus. The promoters have sold about 50 lakh shares via block deals at 1180 rupees a share. So just keep that on your radar. It's seen a big rally, but today, little bit of profit taking there. Signature Global has launched a new project under the affordable housing policy in Gurugram. So that stock in focus as well. And a couple of other names that you mentioned a while back is what we are looking at. Sterling and Wilson do now down almost about 5%. Shapoorji says that the stake sale reports is factually incorrect. So the company has come out and said, address those stake sale reports. But otherwise on the market, folks, it's not bad actually, the opening. Decent opening, you'd have to say. The Nifty Bank is higher by 120 odd points. But ITC, that's the big one in focus this morning.
ITC indeed is the big one. In terms of market cap addition, it is like adding half of Britannia, half of Godrej Consumer, and nearly all of Marico to its market cap. And if you're still feeling a little iffy out there, that's like 4 Mama Earths added to its market cap in today's trading session itself. But talk about some other stocks as well. BSE is the one that stands out in terms of an up move. It's up around 3% this morning. There was a note coming in from Jefferies as well that the 1% cut to transaction charges made by the NSE would be a periodic exercise by them, and the quantum is smaller. BSE's product pricing and monetization plan of new products will be unaffected by that, and they expect to see an earnings jump of over 2.5 times over the next couple of years. They have a buy rating with a target price of nearly 3,000 on BSE. The other stock which is doing, okay-ish, largely flat right now, is Jubilant Foodworks. That's something that we'll be watching out for. There is a bull and a bear case out there. The bull case is that, there is a positive development that they've had with regards to the movement in Turkey and Bangladesh. But the bear case is that sales for India business itself haven't been growing higher, and there is the risk of that Turkish lira depreciation in that business as well, still holding mildly in the green. A couple of these auto ancillary names are doing well as well. JBM Auto, for instance, is higher. We're seeing decent moves come by on GMR Power as well, which is up around 3%.
All right. Well, Tahir Badshah, CIO Invesco Mutual Fund, is joining in now to tell us how to approach the markets. Tahir, hi, good morning, and thanks for joining in. So, everyone's talking about how the mid and small cap space is under pressure. But to be fair, the small cap index is down 6% this month, but it was the biggest performer last year. So do you think the concerns are unwarranted, or would you now start to get a little more cautious about what's happening in the broader markets?
So I think, Sonia, we have been moving a little more cautiously compared to what we were, let's say, during the later part of 2023. And our view has been that while we still feel that overall the market is constructive and even the broader markets are reasonably constructive, but we have somewhat, we have to worry a little more about risk compared to what we were in 2023 because valuations have gone a little elevated compared to last year. So I'm not necessarily surprised to see the correction, and a modest correction was on the way. Probably we have seen, like as you said, about a 5-6% correction. Much of the correction up until now has been driven by the valuation argument. It has not necessarily come down to the stage where we have started to question the earnings capability or the earnings power of the broader market in the near to medium term. And to that extent, therefore, I would like to think that the correction should not probably be very deep. We've seen, like as I said, about a 6-odd%. Can we do another 5-6-odd%? And then valuations start to turn reasonably more favorable for one to take a lot more constructive stance. Meanwhile, we also need to understand that quite a lot of the recent correction has been induced by some of the regulatory headwinds that we have faced both from the market regulator as well as the financial regulator.
Right. One other stock which is actually doing better in today's trading session has been United Spirits. It's up around 1.5%, more to the high point of the morning so far. And this perhaps because the street is reading a little more into the tweet that was put out by Prime Minister Narendra Modi, where he did say that they reaffirmed their commitment. That's with regards to the UK-India Free Trade Agreement. He had a good conversation with PM Rishi Sunak, and they expect that there could be an early conclusion of a mutually beneficial free trade agreement. If that was to happen, then all the bulk scotch that comes into India will perhaps not attract as much duty, and that may be margin accretive, provided all other taxes remain the same as well. So that's something we'll be watching out for. Tahir, your thoughts on specific spaces, consumption in particular, discretionary, where a lot of people are positive because they believe, the wealth effect is leading them to buy better, not necessarily more.
Yeah, I think so. This whole consumption space has had a very divided kind of, scenario, seen a very divided kind of scenario in the last some time. And that trend by and large still continues. I think, from at least a growth standpoint, the mid to higher end segments of the market clearly seem to be relatively better placed in terms of further growth momentum. We can always argue about what companies in that particular space, but stocks of particular companies in that space are doing and where valuations are. But by and large, I think that is something which appears to be relatively more structural. Wealth effect is obviously a little more pronounced in that segment of the market. It's not to say that the mid to lower end segments of the market are not seeing wealth effect, but the impact is relatively muted, and it has been there for some time. I think that also to us seems like there could be a possibility of a cyclical recovery out there, and the impulse on growth out there could probably be a little stronger than what it has been in the last 2-3 years. But that's something that we are approaching very tentatively. We are examining some pockets of that segment which have underperformed and where growth has lagged. But I think the upper end of the market clearly seems to be in a strong saddle and seems to be a lot more structural in nature.
Okay, all right. Hi, Tahir. Tahir, when we met the last time around, you were saying that, BFSI is still worthwhile, though you didn't have any exposure to gold financiers. RBI has wrapped the knuckles of a couple of NBFCs or financial institutions in the last week or so. What's your view currently? How would you approach this entire BFSI theme? Will it be private? Will it be public? Or is there select NBFCs that you like?
So I think, Nigel, the last time that we would have discussed, I would have also probably said that, we did start to develop a preference more for the banks. We didn't really call out as much on NBFCs. We still are relatively light on NBFCs. You mentioned that we also don't have exposure to a few segments. But that divide or that tilt still remains, that we have still a little more bank heavy than NBFC heavy. And then on the other side, we are obviously heavy more on some of the non-lenders. So, to that extent, that probably has worked out reasonably well, I would say. So the preference still continues a little bit more for the banks. The impact has been relatively less for the banks from a regulatory standpoint. And within the banks, I think there is a edge of private sector banks over public sector banks to some degree. And not to say that we don't have a presence in public sector banks, but incrementally, do we see a little more value and the growth differential and the valuation differentials now having kind of, leveled off between the two parts? We think so. And that is a view basically that we are going with, at least for 2024 as things stand now.
Okay. I know you may not want to comment on individual stocks, but I have to ask you about this move on ITC, right? The market is hungry for companies, good quality companies where valuations are looking attractive, and ITC is one of them. Do you think FMCG in general is that space which will now start to perform as valuations are not as expensive as some of its peers?
Yeah, so time and again, Sonia, these stocks in these segment have, presented themselves as a value proposition, and we have taken advantage of them as well. But, at times we want to, are they deep value? Probably not. Are they value in a certain context relative to their growth? That needs to be examined. And in certain cases, we see some bit of, like as I said, a growth impulse as well, whether it be in the FMCG category or even in the consumer discretionary space at the low to mid end of the market. But we need to see it in conjunction with the growth outlook. And like as I said, there is a cyclical possibility. We are looking forward to inflation cooling off, and that obviously has affected these segments. So there can be a cyclical rebound if inflation continues to be on its easing path. We obviously have the initial monsoon assessment that should come about in the next some time. And that will provide a good cue in terms of what we can expect out of this segment as well. So I think we are examining it, as and when we see opportunities around it, but we don't want to be in completely deep value pockets either.
Where else are you finding value right now? Because, everyone's talking about this optimism around India, but also it coming at a price. A lot of foreign paper has been supplied into India. They're doing the valuation arbitrage here. We've seen, as Sonia pointed out earlier as well, the third foreign promoter actually cashing in on the Indian chips that they own. What are your thoughts? Where do you find value right now at a market which is so hot, so to say?
Yeah, so what we are seeing is relative valuation pockets, not necessarily on absolute terms. Absolute terms, probably where we see value is, like as we discussed, only in the banking and financial services space, and could probably include even some select NBFCs. But apart from that, in most other pockets, it is more of relative valuation. We do see some, not necessarily strong value, but we see relative value in, let's say, the pharma space. That's something where we see the earnings rebound to be relatively stronger. And while even there too, valuations in the recent past have moved up, but compared to, let's say, the 5-year averages, we are not at very extended levels, and dynamics are changing out there as well. So we are looking at value pockets where we see simultaneously certain inflection points. I mean, if they're without inflection points, then it becomes a little difficult to spot. I think we are tentatively approaching, like as I said, some of those lower end segments of the consumer market. We are also, examining certain pockets in the commodity space, which perhaps have underperformed and where we could see somewhat better headline growth compared to what it has been in the recent past. So it's selective. I mean, I wouldn't call that. We all know that it is not a market where we've got some very value which is strewn around all over the place. But I think these are the pockets where if we hunt a little more closely, we're likely to find some opportunities.
Okay, all right, Tahir, how are you placed on the autos? Two-wheelers, some of them have rebounded big time. Bajaj, Hero, they've done quite well. Royal Enfield had a bit of a scare, but that one as well has bounced back quite well. On the two-wheelers, how are you placed? And on the whole, what do you like from the auto space at this juncture?
Yeah, so I think in the GAP segment section of the market, clearly two-wheelers at this stage is appealing. And this is where we are a little more exposed, I would say, compared to, let's say, and is where we have probably added to positions in the last some time compared to, let's say, the four-wheelers. It's interesting to see that, the product momentum in the two-wheeler segment, whether it be in EVs or even in the ICE segment, is of a somewhat better order compared to what it has been in the last 2-3 years. And in fact, we are taking a little bit of that segment as a possible indicator of a more broad-based revival in the lower end of the market. It traditionally has panned out that way. We'll have to see how it goes, but that gives us that little extra confidence that we might be able to find some more ideas in that space. So clearly in the auto space right now, it is two-wheelers. We are not too excited about the four-wheelers. There are a couple of places where now valuations have become a little more reasonable, or even to some extent, I would say cheap. So maybe there is some attraction out there, but heavy positions are largely in two-wheelers and auto anchs.
But in two-wheelers also, just one follow-up there, names like, say, a Bajaj Auto, TVS Motor have already been, big gainers, right, in the last 1.5 years. So do you believe that this is a structural upcycle, that there could be lots more to go and it's just the initial phase in two-wheeler names?
No, so clearly, once again, in this segment, there are winners and there are companies which are executing a lot more strongly compared to some others. And, in certain cases, the entire revenue mix is doing reasonably well, whether it be their two-wheeler portfolio, whether it be the EV part of the two-wheeler portfolio, in certain cases, even the three-wheeler opportunities. So, to that extent, we are able to tolerate somewhat higher valuations in some of these, especially if all cylinders are firing at the same time. And, they've got their, like as I said, product profile and they've got their execution, and then that makes a lot of sense. So I think there too, we are approaching it with the view that, look, I mean, we are paying somewhat higher multiples. But as you said, maybe I don't know whether I should call it structural, but it has also been a cycle which has been quite weak for a good number of years. And therefore, can we have a 2-year upcycle? We are probably in the first year of that. That's quite possible.
All right, Tahir, thank you so much for joining in. We'll leave our conversation at that itself. Thank you for your insights on the market and a lot of sectors where you find relative value and some in absolute value as well. Though, there is weakness in the market, no two ways about that. We've been talking about the weakness in the broader markets. The advanced decline charts come up for you. When we started the show, we had nearly 1,000 stocks advancing for about 500 stocks which were declining. But now that has swiftly moved on. The intersection of those green and red lines have come about, and now they're at the widest point that they've been this morning, with nearly 1,350 stocks on the red side, with around 780 stocks on the green side itself. The mid-cap index down about 0.7%, and the Nifty too has moved into the red. And this, mind you, despite a 40-point up move coming in on account of ITC itself. So no taking away from the fact that there is a deeper weakness in the broader markets. And, one of the stocks that tells you this story is Titagarh Wagons. They've, or rather Titagarh Rail Systems now. They've won an order worth nearly 1,900 crores a couple of days ago. They also announced the launch of another second 25-tug pull tug for the Indian Navy. And usually these news pieces would take all of these rail stocks higher. But look what's happened to Titagarh. It's currently at the lower end of today's trading session itself, down about 3%. So maybe the street is in the mood of profit booking itself. But be that as it may, for this 1900 crore order that has come by, what are the prospects? Is there any upside? And the execution timelines? We have Umesh Chaudhary, who is the Vice Chairman and MD of Titagarh Rail Systems, joining in. Good morning, Umesh. Thank you so much for joining in. Every time we speak to you, it's on the back of a big order that you've gotten. This time around, it's around 1900 crores coming in from Indian Railways. Could you tell us, what the execution period for this is, margins, and what does this take your order book to?
Yeah, hi. Good morning. Always a pleasure being with you. So this is an important order for us because this is for a new design of wagon, which we got an order for.
Oops. Umesh, I think we've lost your video there, so we'll just come back to you in a bit.
Someone's pulled the chain on that train.
I couldn't hear him or see him, so we'll get back to that in a bit. But by the way, guys, you should look at the broader markets because that is the big concern area. Look at it now. The mid-cap index is suddenly down 420 points, and that was the point we were making earlier in the morning as well. While the headline index is fine, it's steady, it's the broader market pain that is really hitting retail investors quite a bit. So right now, 400 points gone on the mid-cap index. The advanced decline ratio is at 1,500 stocks on the declining side. So that is the big headline at the moment. But back to the discussion.
Back to the discussion. Yes, Mr. Chaudhary, I believe you can hear us clearly. Let's hope we can hear you clearly now as well. You were telling us a little about the order.
Yeah, absolutely. So I was saying that this order is significant for us because this will be executed in just under 2 years from now. And this enables us to maintain the market leadership position that we have currently in the wagon space. So it's an important order for us.
Okay, it's an important order. Can you tell us a little bit about what the total order book that you're sitting on currently is about 28,000 crores, right? How much of that will be executed in the next 1 to 2 years? And, what is the kind of order visibility that we're looking at? If you can help us with some details.
So we operate in two segments, the freight and the passenger. On the freight side, the last order book that we had declared along with our December results is what I can actually speak about. So that was about 28,000 crores divided half and half into both the segments. In terms of the order pipeline visibility, so in execution, so we announced along with our December results that we were able to break the glass ceiling of making 1,000 wagons in the month of December. And our target now is to make sure that we are able to consistently maintain that. So we believe that by Q1 of FY25, we will be able to hit a run rate consistently of 1,000 wagons a month. That is where we intend to be for a while now, unless we see the new dedicated freight corridors and the next big demand of wagon going upwards. In terms of the passenger rail segment, there are many tenders in the pipeline. We have the Chennai 2 tenders, we have the Mumbai 3 tenders for the metros. Of course, the new Vande Bharats that have been in the media that will be announced, but probably after elections. So we see for both the segments, the visibility is quite large. And in terms of the execution of the passenger side, the Pune Metro will be executed in the next couple of months. The order will be completed. And we are starting with the Bangalore and going on with the Vande Bharat and Surat, etc. So both the segments, I think, are going pretty much as per target.
Just to get the number, the total order book is 28,000 crores, right? If you can just break it up for us on the freight side, what is the order book and what's the visibility like?
So on the freight side, the total order was approximately for the wagons about 7,000-8,000 crores, and I'm speaking from memory, so I can be a little bit here or there. And then there was the wheel, our share of the wheel project, which was the balance. And on the passenger side, including the maintenance, was about half of that. So it was if I look at the wheel and the wagon as one pocket and the passenger on the other, it was equally split between the two.
Okay. Hi, sir. Good morning. Nigel on this side. Just want to confirm this order that you won. In which segment does it fall?
Freight.
The recent
order?
on
the freight side. This is the wagon order.
Got it. Wagon order. Also, if you could tell us, you told us by when you will execute it. That's the next 24 months or so. But what are the margins you'll enjoy?
So the similar margin. So on the freight side, we've had about 12% EBITDA margin, 11-12% is what we've been maintaining. And this order also would be no different.
So 11 to 12% is on the freight side. Now the next trigger of revenue recognition will come in as you execute the passenger segment. Like you said, there'll be the Bangalore Metro, Pune Metro, and all these Vande Bharat orders that you would be giving. What margins do they typically apply at?
So, if you look at, and as you said very rightly, Mangalam, that up till December, almost 80% of our revenue or even more was coming from the freight segment. In FY25, we will really start getting the revenue from the passenger segment, which will significantly ramp up in FY26 when Vande Bharat execution starts. In terms of the margin that we have in the passenger segment, if we look at the bare coach, when we are buying propulsion, we expect a 10% EBITDA, which will increase to 15% when we are able to do our own propulsion, for which we have now the technology tie-up or the TOT with the ABB. So ultimately, if we look at the passenger segment, the targeted EBITDA margin that we have is around 15%.
Okay, EBITDA margin is around 15%. Got it. Can you tell us, in terms of the private sector orders, what is the expectation currently? What is execution looking like? What is the visibility?
So we have a significant part of the private wagon business as we speak, and we don't normally give the split between the two, between the private and the Indian Railway wagon for competitive reasons. But I can say that for certainty that we have a significant market share, if not market leaders, in the private segment also. And the visibility looks very good. And this is clearly driven by the economic activity. So, right now, because of elections, new capexes will be a little slower. But as soon as the election is over, we will see new capacities, whether it's steel building or cement or all of that come up. And that will again bring up the demand for private sector wagons. Having said that, we have substantive orders right now, which will see us through for at least the next 8-10 months on the private sector wagon also.
Okay, all right. Final question, sir, before we let you go. What is the execution outlook? Order book is looking superb. You're bracing yourself to go to 1,000 wagons per month in FY25. On the base of FY24, what kind of a revenue growth can you deliver? Point number one. And give us the blended margin for the business that we should be working with.
So in terms of the execution in FY24, we were hovering at the run rate of around 700 wagons a month, and going FY25, we are targeting a run rate of 1,000 wagons a month. So that pretty much gives you a kind of a sense of.
You want to give it to us, sir, in revenue terms? In revenue terms, you want to give it to us?
We don't, as a matter of policy, give forward-looking projections. So I would refrain from doing that.
Let's try it this way. Umesh, you have a higher share of revenue coming in from passenger, wagons, which will be better margins. What are the realizations per wagon that you're targeting next year? Let's put it that way.
So realization for freight wagons continue to remain the same. So it is not changing. It doesn't change apart from the normal price variation, which is reflective of the inflationary trends. So the revenue per wagon hovers between 35 to 40 lakh per wagon, and that is where it will be. The volume what will drive the overall top and bottom line. On the passenger side, we were at about 3 to 4 coaches on an average, if you look at FY24. This we are targeting to take it to almost 15 coaches, 12 to 15 coaches in FY25, and then double it up from there in FY26, and then further increase in FY27. So the real big delta will start coming in from the passenger coach segment, and while the freight segment will go from 700 to 1,000 in the next year.
So basis your numbers, roughly 4,800 crores is what we're gathering, because 1,000 wagons per month at between 35 to 40 lakh per wagon would mean about 400 crore revenue per month. Multiply that by 12, 4,800 crores. Would that be a fair estimate?
You have better mathematics than I have.
All right. Thanks a lot for joining in, though. Appreciate your time here on CNBC TV18. Let's step into a quick break. On the other side of the break, Ameera Shah of Metropolis Healthcare will join in to talk about the new advanced diagnostic testing centers launched by the company. Later, we'll connect with Lalit Agarwal of V-Mart Retail to talk about demand trends and their business outlook going forward. Stay tuned.
Welcome back. Well, as we speak, the markets are flattened out, but the real action is in the broader markets. You have the mid-cap index is down 1%, and the small-cap index as well is down close to around 1%. So some pain continues in the broader markets. Well, let's focus on Metropolis Healthcare. They've launched new advanced diagnostic testing centers in Maligaon, Maharashtra, and in Dehradun. To discuss these centers as well as their expansion plans, we're now joined by Ms. Ameera Shah, the promoter and MD of the company. Hi, Ms. Shah. Morning. Thanks so much for joining in. Well, before we get to these expansion plans, just wanted to ask you first, how is the competitive intensity in the industry as of now?
So, broadly, I think we've always had lots of competition in the industry. It's not something new. I think healthcare services has traditionally, and especially diagnostics, people assume it to be a low entry barrier market, which is true because there's no regulatory framework and capital required is low. However, what I think people realize after they enter that actually the barrier to scale and the barrier to earn good quality business is very difficult. And that's where you will end up having lots of companies in the industry, but a lot of them become zombie companies after 5-6 years of trying and not being able to really succeed in the way that they estimated. So I think competitive intensity was there, continues to be there, but is lower from a perspective of aggression, pricing, discounting than it was a year ago.
Got it. All right. So it's easing a little bit. That's the takeaway from what you're saying. Going back to the expansion plans then, how many labs have you added in this fiscal so far? And what's the plan from here on?
So our target was to add about 30 labs this year, and we're very much on our way to get there. So hopefully by the end of this month, we should be close to that target. And we've also added approximately 600 centers. New centers all across the country as well. And that's the kind of pace that we look to keep going. Even next year, we're looking to add about 30 labs and again about 600 to 650 centers, across, mostly in tier 2, tier 3 markets and markets in which we are challengers in the country, across the north and the east and the central part of the country. And of course, while we'll keep going deeper into our core markets of south and west, we'll also continue to broad base our entry and access points into northeast and central.
Okay. Ameera, hi, good morning. This is Sonia here. I take your point about, the brand strength and how that is sort of helping you overcome competitive intensity. In fact, in your B2C segment as well, you've seen a growth of 13% in patient volumes, and that B2C is 53% of your overall sales. Just tell us, is this double-digit growth something that you can sustain? What are you doing in the B2C segment to strengthen your brand presence pan-India?
So you're right, Sonia. If you look at it, the volume growth in B2C was 13, but the revenue growth was closer to 17-18%. So it's been very strong. And, really what we've been doing is about, Metropolis we've always built our business on the back of a science and expertise and not on deep discounting. And we continue to do that. So it's about really having a right to win as far as your service and your product and being able to communicate that to doctors and specialists all over the country. And, with that belief in our brand and what we bring to them, which helps them in their treatment, is really how we are able to drive the B2C, which is basically having earning our trust with doctors. Now, what happens is once in a market, you've been able to earn your trust with doctors, and over time, it becomes a consumer brand. And then you can also do D2C, which is direct to consumer activities that will, bring the consumer to you directly as well. Now, the mistake often people make is thinking that, we can go directly D2C. But if you haven't earned the trust of doctors in the meantime, then frankly, the quality of business you'll get from D2C will not be so great.
Okay,
Right.
So just one follow-up here. The overall growth rate in the B2C segment for the industry is expected to be how much in the next 1 year? And how much will Metropolis's growth rate be? I'm talking about FY25.
Sonia, that third-party data is unfortunately not available for our industry at all. We don't even get really overall growth data for the industry. But my estimate is the industry is growing at about 10%, year on year. Where the unorganized segment, which used to grow at about 5 to 6% per year pre-COVID, is actually growing slower, and the organized market is actually growing a little bit faster. This 10% is obviously a combination of volume, price, RTT, combination of everything. And as we've seen in the first 9 months of the year, our core diagnostics growth has significantly outpaced the rest of the industry as well as the rest of our listed peers. So I think we want to continue focusing on volume plus revenue per patient plus pricing as the three levers that will lead us to a superior revenue.
So let's talk about all those three drivers itself. What is the kind of volume growth that you are targeting in the next quarter and maybe FY25, if you can give us a sense on that? The price hikes that you've taken so far, the target price growth, and finally coming in from your new centers. I remember you saying that the revenue coming in from new centers and premium centers would increase in contribution. Where do they stand and what's the target there?
So if you see Y to date till about December, we've done about 9% volume growth, which has been sort of significantly higher, like I said, than the industry. Plus, we've had about 3% of revenue per patient growth, which is really about the product mix changing and people moving up sort of more advanced testing. And that increases the revenue per patient as a single prescription point. We have rolled out our new pricing initiative on Jan 1st, 24. So that impact will come in Q4 and obviously for the next year as well. So we don't have a specific number on that yet, but that should add a few percentage points as well.
So the B2C price hike has been absorbed is what you're telling us. No worries on that front. What about B2B? I think you'll be looking at pushing through a price increase there as well. When is that?
That's right. The original plan was to do it in Q1 of FY25. But I think we've already rolled it out in Q4 as well.
Okay. The premium wellness space is something we've discussed ad nauseum, right? But it's a space that's also picking up in a big way. There are wellness centers sprouting all over metro cities. But for your own business, it's done pretty well. I mean, your Q3 premium wellness revenues were up almost 15%. Tell us a little more about how you're planning to expand this segment and how you're planning to, sort of cut away from competition.
See, again, I think it comes back to your product, your offering, your service, and the trust in the brand, right? So when there is a lack of trust in the brand, and when I say trust in the brand, our business is not built on the back of hoardings and marketing materials. It's really built on the back of experience when you're unwell. And who are you able to trust when you're sick? Usually you trust the best doctor, the best hospital, the best diagnostics. And that's the kind of reputation that we have. So people understand that when they're doing a wellness checkup or an illness checkup, they're doing it once a year. And they're not spending huge amounts of money on it. Usually when you come for a blood test, you're spending maybe 1,000 rupees, 800 rupees on it. It's not a huge amount of money, for an upper middle class customer. And you're doing it once a year, right? It's not a repetitive thing. So people are actually tend to be more careful about where they go, and they're not looking to just get excited by discounts and cheaper prices and all of that, because they also realize that tracking their reports, their results, their data from the past, all of that is meaningful to their health. So I think overall we are seeing that the premium wellness segment is basically bundling. But with the brand trust we enjoy, people are willing to pay fair prices for it because they don't find them to be expensive. And even here, the price points are closer to 2,500 to 3,000. It's not like it's 20,000 or 10,000.
What's also standing out is the fact that you are looking to grow beyond metros. An advanced diagnostic center that you've opened in Malegaon, another one in Dehradun. You are looking to expand beyond just the metros, and that's where a lot of people are eyeing consumer opportunities as well. What I wanted to understand are the economics of opening stores or diagnostic centers outside of metros. How do they compare with mature stores when it comes to revenues and cost? And would there be a bearing on your margins on account of something like this?
So usually in a tier 2 market, you're starting what we call as a stat lab, which is you're doing about 150 varieties of tests. unlike the 4,000 varieties of tests that we do in our global reference lab in Bombay, right? So you're starting a smaller limited test menu in that market, but you're offering all 4,000 tests to, let's say, all the citizens of Malegaon or Dehradun, right? Because you can do some testing locally and some of those samples will then flow to the closest lab where you are able to do everything else. For specialized tests, for semi-specialized tests, the pricing is actually the same across the country. It's only for routine tests that we have some adjustments based on the local market. So overall, you find that there's not a huge difference in pricing. But in your cost base, there is a big difference. Because, obviously your OPEX costs are lower in these tier 2, tier 3 markets. So overall, as a weighted average, and really the dependency is on where you have a strong brand with doctors and medical community and where you don't have still a very. So in markets where we have a very strong brand, we see a quicker payback. Markets where the brand is not as strong, it takes maybe a year, year and a half.
So how should one read margins going forward? Should we see an improvement or should we see them maintained at the current levels where we are?
So currently we are at the peak of our accelerated lab expansion, like with 30 labs, and next year will be the same, which is FY24 and 25. But post FY25, we are going to then go back to adding, 8, 9, 10 labs a year like we used to in pre-COVID. And that accelerated program will stop. And therefore the drag on the margin, which is currently about 1.2% because of this accelerated lab expansion, will certainly reduce and come to a complete end by FY26-27.
All right, Ameera, always a pleasure hearing your thoughts. Thanks so much for stopping by and filling us in with all of those details. Wishing you well and looking forward to chatting up with you post your quarterly numbers. By the way, we need to keep an eye out on the markets. We have dipped below the 22,300 odd marks. A good time to get in Mitesh Thakkar. Hi, Mitesh. Welcome back on the show. Well, the market started off well in the green, but you needed some more participation from a couple of other heavyweights to build on. That hasn't happened. Would you be looking to buy into this dip on the Nifty as well as the Nifty Bank? Give us the levels out there and then fill us in with your picks.
No, Nigel, I think good morning. I've been advocating, selling into this market via put options route and saying that 22,250, 220 is the first support area. But the way the indicators are positioned, there's a stronger chance of us breaking below that level this time. And if that happens, 21,950, and in the worst case scenario, 21,800 can be tested. So maintain a negative bias. We've disclaimer here that I've bought 22,500 April expiry puts. So I have vested interest. I have a position in that sense. But yeah, I think the overall outlook is slightly on the negative side. Similarly, the Bank Nifty, I think once it breaks 47,200 or 150 on the hourly closing chart, then I think we might see the Bank Nifty dip to about 46,500, 550 levels. So mild negative bias on both the indices. Okay. On the stock side, sorry.
Please go ahead. Please go ahead.
Yeah. On the stock side, PNB is a sell. We had a sell on PNB yesterday as well. It's a recommendation to our clients. So again, there's vested interest. But keep a stop at 126. Look for targets of 117 here. And the other stock is Colgate-Palmolive, which I would take as a contra bet on the long side because we have mostly short positions. So Colgate is a buy with a stop at 2587 for targets of around 2670.
Okay, thanks a lot for that. Well, the market is definitely taking a turn for the worse now. The Nifty is down 55 points and the mid-cap index is really out of shape as we speak. 860 points gone on the mid-cap index. A lot of pressure seeping into the broader markets there. But let's focus on V-Mart Retail. The stock is down nearly 10% in trade in the last 1 month. In Q3, the company saw a single-digit same-store sales growth while margins were around 17%. The demand environment has been quite subdued actually. How is business looking now? We are joined by Lalit Agarwal, the founder and MD of V-Mart Retail. Mr. Agarwal, good morning and thanks for joining in. You have spoken to us in the past talking about how demand is under pressure in certain pockets of the market. Can you just give us a little more, color on that? How is the situation in tier 2, tier 3 cities, in the rural markets? Have you seen any improvement as far as consumption patterns are concerned?
Yeah, I can see you.
Yes, Mr. Agarwal, can you hear me?
I can hear you.
Okay.
So,
yeah, go ahead.
I heard your question. Yeah. So the demand definitely has been creeping upward and better. There is still some pain in the smaller town. There is still some pain in the consumption because inflation pressure has been continued on the base of a high inflationary piece. So, but yeah, we are seeing some green shoot because we reported some single-digit quarter in the last quarter, single-digit like-for-like growth, and we are expecting a little similar kind of growth continuing also in this quarter Definitely till this time, it has not been so great, but March should be a good month. This is what our expectation is, because there are a lot of marriages as well as a lot of festivals which are coming up in the month of March. So we should see some betterment coming in the month of March as well as April.
Okay. When you say some betterment, can you just quantify that for us in terms of a revenue growth or a volume growth? What are you looking at? Because your same-store sales growth has been in single digits, just about 4% in the quarter gone by. By when do you think you can get to double digits?
I think it will take some time for us to reach to double-digit numbers, and that's what our expectation always would be. But right now, whatever we are seeing, we will be hovering around the same single-digit number, and that's what it looks like. The way the consumption is growing, the way there are income generations happening in the market, the way customers is able to have a disposable income, we are seeing some kind of pressure there. But yes, definitely we are seeing green shoots coming in, and those are the good news which are being seen from a lot of markets, especially from TFO markets. Some of these green shoots is making it much more confident, us much more confident that this is going to be definitely a better year for us coming year.
So, we have a lot of other triggers as well, the likes of elections, etc. Tier 4 markets showing some green shoots. Mr. Agarwal, what does it imply in terms of growth targets for the next year? What are you looking at in terms of same-store sales growth, revenue growth, and maybe some bit of margin improvement for the current levels that we're seeing?
So next year we are definitely hopeful, because we definitely know that election do bring in a little more money into the market, and it is a better economy after that, and especially in rural as well as the semi-urban towns. So we are expecting a better outcome coming forward. Definitely there will be highs and lows, but yeah, we are expecting a higher single-digit same-store sales growth, and overall higher double-digit same-store or total growth. And that's what we are expecting. And there are a lot of initiatives that we might have initiated in terms of its ability to provide the best value for fashion to the customer. So we are actually focusing on improvising our internal processes, our internal capability to deliver the better fashion to the customer, and then targeting that customer. So that is which will also bring in some kind of result. That's what our expectation is.
Okay, all right. Hi, Ms. Agarwal. Good morning. Good to see you in. Nigel on this side. Yarn prices as well have dipped a little bit. How does it help you, and what's the outlook on margins?
Yarn prices have been moving a little upward and downwards. There was almost a 1 month of period where we saw a little higher in the yarn prices, but it is now coming down. So largely, see, we don't create a clear correlation with margin, and these yarn prices are only maybe 30% of the total apparel cost or 25% of the total apparel cost. So there is some impact which does happen on those, but largely we believe that the margin should be constant. But yeah, because the consumer is in pressure, we have reduced our average selling price for this year, and we have gone almost like 10% lower for the complete year. So in the next year, we would want to keep our prices stable, maybe take it down a little bit more, but not focus on increasing the prices, because we believe our customer is in pain and we need to support them in those pain. For that, we are definitely bringing in a lot of new processes, new sourcing mechanisms, and integrating with mills and fabric or manufacturers, so that we are able to deliver a quality product with the best of the fashion which is available to the customer. There is also a lot of innovation by these textile companies, and there is a lot of innovation in terms of mixing the polyester as well as cotton yarns. So there is a lot of new kind of fabrics which is coming to the market, and because of PLI schemes, a lot of investment is also happening in the textile sector. So some of those things are also bringing down the price of the fabric, which is also making it reasonable for the customer to afford those apparels.
All right. Thanks a lot for joining in and giving us an update on the business. Let's step into a quick break. On the other side, we'll put focus on the commodity space with Manisha Gupta. Stay with us.
Welcome back. The markets weakened a lot, and the Nifty at the low point of trade right now, down almost 65 points, over 100 points off today's high as well. In the mid-cap index, that's where the pain is, 2.5% lower. The index has shaved off 1,100 points. 2,000 stocks now declining for about 200 stocks, which are advancing. So there is red all over the screen. Is that the case for commodity space as well? Perhaps we'll get to Manisha, and she'll tell us the commodity that she's tracking today. Manisha.
Well, thank you for that, Mangalam. I'm looking at an underperformer within the metal space, and that clearly is iron ore prices. We saw nearly 7% of a decline at one point in time in the China markets there. So when you look at the last year, it was a 25% of gains. But in last 1 week, we've seen 4.5% of decline. The last month has seen 14% of a cut. And in this year, until now, we are down by 25%. So all the gains that you saw in the previous year are done away with in the first 3 months of this year itself. This is to tell you on how the iron ore prices have been moving. Well, we did see an all-time high of $229 a ton. That was way back in July 2021. By 2023, we did see prices decline quite a bit. In 22, we saw a low at $85, and from since then, it really has been between 85 to 150 on the higher side of a range that the iron ore prices seem to be trading within. Now, when you look at 23, the range, the lowest was 99, the highest was 145, and that's exactly how we started January 2024 as well. We started Jan with $142 a ton, and currently we are trading at around $110 on the lower side here. So it has been a sharp correction that we've seen on the lower side. As you can see, it only has been a one-way decline that we've seen in case of the iron ore prices in this year until now. Well, China accounts for 70% of the global seaborne iron ore, and we do understand that the inventories there are quite strong. This is what we've done in sense of million tons of trade for the last couple of years. It has been increasing, and as I said, even at 1,700 tons of an anticipated global trade of iron ore for 2024, 70% of that will happen from China, and that is where major concerns really seem to be building up in. So when the property demand comes in, that number has been on the weaker side. The last few data from China have been slightly positive. So whether it's about shipping, machinery, auto and infrastructure, we have seen some better steel and iron ore demand coming in, and that is perhaps where we are getting support from as well. But it also has to do with the high iron ore inventories. Australia and Indonesia are pushing out a lot of iron ore. Yunnan in China is saying that they will cut steel output by nearly 300,000 tons to 500,000 tons. So that would mean lower iron ore demand, and that's weighing onto the prices as well. Also, with Moody downgrading the second largest property developer in China, Vanke, to junk rating is also weighing onto the markets, with Street now telling us that while the iron ore prices are trading at 110, but watch out for $100 a ton as well, and that could perhaps happen in the next couple of months itself.
Okay, thanks a lot for that. Well, moving on, Vivek is joining in with details on the FTSE and the Bharat 22 indices rejig that is expected this week. Vivek, over to you.
Well, that's right. So the flows or the actual rebalancing will happen in the trading session of Friday, that is March 15th. Now, all the flows that we have are as per IIFL Alternative Research. So the FTSE rebalancing event, is a positive net inflow event as far as Indian markets are concerned. In fact, it's quite sizable. It's a $1.85 billion inflow event, the entire FTSE rejig. Now, there are 16 stocks that are being added into the main index that we track. That is the FTSE All World Index. Couple of stocks where there will be higher impact given the kind of flows and when you're comparing to the average daily traded volume. So the first stock is Sundaram Finance, almost $160 million of inflow. Suzlon Energy, over $110 million of inflows. The other set of stocks, all in the range of $50 to $100 million is what they will see. So you'll see names, you'll see inflows in names like Phoenix Mills, KPIT Tech, Jindal Stainless, Prestige Estates, Thermax, LJV and Metro Brands, NLC India. NLC India has been very volatile in the last couple of trading sessions. Metro Brands, Poonawalla Fincorp, FACT, that is Fertilizer and Chemical. You also see Kalyan Jewellers, Melcon Dock, RVNL and New India Assurance. These last four names will see flows in the range of $10 to $20 million. Now, along with that, Bharat 22 ETF2, that also will see a minor rejig in terms of weight changes. So which are the stocks that have seen getting their weights added up? ITC, Axis Bank and SBI will see their weights gaining. On the other hand, there will be outflows on account of weight decreases in BHEL, NTPC and Power Grid. Now, very important to note is HDFC Bank. FTSE will go ahead and implement the third and final tranche of its weight increase in this particular rejig. So HDFC Bank will see inflows of over $450 million on Friday on account of this particular rebalancing.
Okay, thanks a lot, Vivek, for that. Let's slip into a quick break. On the other side of the break, we'll get you excerpts from our conversation with the top macro voices at the Citi India conference. Stay tuned. Well, at the Citi's 2024 Investor Conference, Prashant caught up with the Chief Emerging Market Economist of Citi, Joanna Chua, and began by asking her about the China +1 factor for India, India's growth trajectory, and lots more. Listen into the slice of that conversation.
we're still in the early phase of that process. Clearly, when you look at surveys of greenfield investment, I think that there's a lot of optimism in India. Obviously, India has had a lot of positive momentum from previous reforms, like the PLI schemes, a lot of improvement in infrastructure. So from the timing perspective, India has had its own domestic reforms happening at a time when the world is also looking for alternatives of China, China plus one. So you have this coincidence of wants. So I think it's positive. Of course, the challenge here is that you also have a global manufacturing cycle that we need to see demand to be strong enough. And the challenge here is that China, it's not like China is going to give up its dominance in global manufacturing without a fight. And China is still very competitive. And we can see that across a broad array of goods. So that does pose a little bit of competition. But for now, especially for India's domestic market, there's a lot of long runway to go. So I think we are very optimistic that this manufacturing story can continue.
How would you rate it? I mean, it's an unfair question maybe out of 10. I mean, how many marks would you give this process? Because the other country which has benefited and which perhaps will benefit is Vietnam, right?
Yes.
And that also ranks in the conversation as one of the big beneficiaries. But where would you rate India?
Okay, so in Asia, I mean, globally, obviously, people also look at Mexico for nearshoring. But in Asia, you're right, Vietnam and India ranks high. Of course, the challenge for Vietnam is still a very small country, right? And it depends a lot of its supply chain ecosystem with neighboring China. So they're very linked. And so I think the challenge here is that, to a certain extent that Vietnam doesn't have a large domestic market, it also has to face competition for nearshore. Like if you want to service the US market, which is where a lot of exports in Vietnam go to, you have to kind of compete with nearshoring destinations like Mexico because you don't have a large domestic market. Now, the nice thing about India is there's a lot of large domestic market, and that makes it more attractive for companies also to go into India. Of course, you have to balance the ecosystem for investor climate and whether there's enough of a complete ecosystem of supply chain in India. So, I think in Vietnam, it's very linked to China, and China has a very complete ecosystem. The question is, will India be as open to imports of parts to make that kind of a seamless kind of manufacturing kind of system is something that needs to be we need to monitor, because obviously India also wants to develop its own domestic supply chain, but these things don't happen overnight. These things take time.
Is there a hindrance? I mean, the PLI schemes, the government supporting sort of own industries, there are restrictions on certain imports, etc. as well. Import substitution is a big theme here in India.
Yes.
So are these two aims at odds with each other, or you think they'll run parallel?
I mean, look, there are sometimes, as I said, sometimes you've got trade policy as a way to support, you use trade policy in India as a way to support import substitution. But at the same time, it's not yet complete. And, you have geopolitics that we have to monitor too. Like China and India relationship is obviously very complicated. If you have a lot of restrictions to certain Chinese goods or restrictions on, say, Chinese issuing visas to Chinese nationals that you need to kind of provide a bit of intermediate inputs, that could create a little bit of friction, right? So I think, again, it's not as seamless, so we need to manage this. And I think India has to be pragmatic, that they have to recognize that some of the intermediate goods they have to accommodate, and some of that inevitably will be coming from China, and then we have to see how that transition goes.
In terms of the business environment, business climate, is it the best ever? How would you rate it? I mean,
certainly. I've been coming to India for many, many years, and clearly the optimism and vibrancy, I haven't seen it as optimistic as we are seeing it now. I've been impressed by the amazing infrastructure. Again, a big part of manufacturing competitiveness is logistic costs. It's not just labor costs. And for sure, there's been a dramatic improvement. But, India is a large country. It's a democracy. Sometimes there's also regulatory issues that you still need to kind of address. But definitely it's on the positive trajectory. And that's what matters to markets. Markets go where they think there's a positive momentum. And I think certainly India has that.
And of course, growth here has been one of the strongest in the region, in the world as well, right?
Yes, absolutely.
And that's well recognized that...
the real GDP growth that came out at 8.4%, that overshot everyone's expectation, including ours.
Yeah.
So I think that also continues to attract money. Again, we are in a world where people are looking for new growth opportunities. China is going through a lot of structural challenges. It's not going to be able to grow as it used to. The unwinding of real estate is going to take a long time. And you've got, to a certain extent, geopolitics that may not unwind anytime soon. And you've got a kind of a model where there's a lot more state intervention that's impacting people's confidence. But in India, I think, again, coming from a lower base, there's a lot more optimism. It's more geopolitically neutral. So that seems to provide a lot more avenues. And to the extent that people are looking for alternative, destinations, that's also diverting capital flows to India.
Do you think geopolitics could be a dominating driver in terms of how trade flows also take place? Because we have US elections.
Yes.
Looks like it's going to be a rematch between Trump and Biden. And if you go by current opinion polls, I mean, you'd give Trump a slight edge even. So are we looking at another big trade war with China? And then how does that sort of effect actually help India?
Well, first of all, there's good and bad, right? Anything that creates a lot of trade and policy uncertainty, drags down global growth, right? Because that creates a lot of uncertainty for investment. So there's obviously some income effect, but there's also substitution effect, right? So you're absolutely right. When you look at some of the rhetoric coming out of Trump's campaign, it's a bit mixed, right? You see things like 10% across the board tariff, kind of non-discriminatory.
I heard 60%.
But then you also have 60% targeted to China. Now, I'm hoping that is just, typical kind of a Trump opening salvo for negotiation. I hope we don't actually get the 60% because that would be very, very disruptive. But you do certainly fear that the antagonism on trade rules are going to be more skewed against China than other countries. And that will kind of probably escalate even the desire to kind of diversify. But again, that is also quite destructive for global growth. But I think India certainly will still benefit from substitution gains. And because India is still a very domestic-oriented economy, so trade as a share to GDP is not very high. So in a way, from a kind of the global, your beta to the shock of global growth, you're a little bit more insulated. And again, as I said, to the extent that, I think we saw Modi and Trump's relationship was a much more cordial relationship. If you think India-US alliance is going to be much stronger, that could again create more positive substitution gains to India as well.
All right, Prashant also caught up with Samiran Chakraborty, the chief economist for India City, and spoke to him about his interaction with the global investors and what do they make of this India as an emerging market. Take a look.
India is now the darling among EM countries, and that has been there for a while. I guess we don't need any more convincing on India macros to global investors. In fact, the most common question for us is what can go wrong rather than what can go right. And that's great. And we expect that this will translate into significant amount of inflows into India. We've traditionally seen a lot of equity inflows, but this time around the focus seems to be more on bond inflows. I think most of the fixed income investors that I have met, not just the EM-focused investors, but also some of the global funds, they're all preparing for the bond index inclusion and bringing in money. And I would not be surprised if the actual inflows turn out to be more than what the mechanically arrived at number is. The question really is on equity investor flows. While the positivity on the macros are there, there are some concerns on valuations. So that's an area where we would probably still have to wait for things like election results, etc. And then the third aspect is the FDI flows, where everyone is looking at their own India strategy, so to say. But again, my sense is that there could be a bit of a time lag between designing that strategy and the actual inflows.
On elections, would I be wrong in saying that consensus does expect Mr. Modi to come back as Prime Minister? There's a little doubt on that?
I think that's where the market consensus is right now. The way I would put it is that the political and policy continuity is already quite well priced in the market. What people are asking us about is the so-called policy delta. What can change after the elections? Are we going to see a significant amount of structural reforms being unleashed? Because in some sense, the whole fiscally conservative, control over inflation, manufacturing push, infrastructure push, these are stuff which investors are by now very familiar with in the Indian context and want this to be continued. But are we going to see more of the land reforms, labor reforms, privatization, agricultural reform, those kind of stuff also coming into the policy playbook? That can significantly alter the way investors would look at India going forward.
Would you say you would need some of that stuff for that delta?
I think so. I think that is something which people would want to see because, as I said, that valuations in their mind has obviously reached a point which is built in a lot of this macro good news and the policy continuity, political continuity. So to see a higher premium for India, we need to do a bit more is what my sense is.
Out of the 3 or 4 things you mentioned, which is the one most doable sort of reform in your mind or area which can be tackled?
So clearly, labour reforms is a place where we have already passed the bills in the parliament. They just need to be enacted on. And the privatization is also an area where we have made some progress and possibly with some political capital we can push it even farther. The more contentious ones are the land reforms and agricultural reforms because it affects a much larger segment of the population. So we will have to see how this can be done in a relatively less disruptive fashion.
You spoke about flows. Before bond inflows, etc. We'll come to that in just a bit. What about FDI in sort of inflows? 2023 was not a great year. I mean, I think...
Again, the data needs to be looked at with some precision here. The actual gross FDI inflow is only down 7%. The problem is that the net FDI inflow is down 45-50%. That's because there's been a significant amount of repatriation out of India. And by the way, this trend in falling FDI, India is not unique here. Sure. Almost all EM countries have seen this. Part of the reason could simply be that higher interest rates in developed world might have made cash stay back there rather than being invested. But I would say that if I look at the trend in gross FDI flow, that decline is not that worrisome. 5-7% decline is par for the course, can happen from year to year, could well be reversed also. The question is that the repatriation that we have seen could be because, particularly in private equity venture capital world, there could be some profit taking in India which could have gone into rebalancing their portfolios. Are we at the end of that cycle? I think that's something what we need to watch out for as we move into FY25. So we have a slightly more optimistic projection for FY25 in our FDI flows, primarily because we think that large part of this repatriation process is already behind us.
Do you think it's behind us?
I think so. I mean, that's what is there in our forecast, especially when interest rates will be likely to be cut in the developed world in FY25. That's when there could be a renewed emphasis on bringing that money into the EM world, and India would benefit out of that. Also, I think there is a bit of a lag between this whole the China +1 discussions that we are having in the Indian context. So we are part of a lot of these discussions, but not as much of that has got translated into flows, which could happen with a lag in FY25 is what our belief is.
Okay, got it. On the bond flows, so this is JP Morgan index inclusion will happen this year, then there's Bloomberg index emerging market will happen next year. Cumulatively, what kind of flows are we looking at?
So it's tough to put a finger on a particular number because there are a whole host of issues here, including even how much is going to happen as a pre-positioning before the index inclusion per se. We've already seen about $9 to $10 billion of inflows into bonds from the September inclusion announcement date. So, but mechanically speaking, this number is supposed to be about $23 billion. Our suspicion is that it will turn out to be higher than that, not lower than that. And increasingly, what it will do is that even funds which are not tracking this index directly, they will have a reason to start investing into India because of the market depth, liquidity, everything that this will bring in. In fact, that is probably the learning that I had in my recent conversations, that it's not just the index tracking funds that will be bringing in the money. It's often even the non-index tracking funds, including some of the global funds, which will start making some allocations towards India. And if we start getting newer indices like Bloomberg's or FTSEs of the world joining the party, then you could see this number to be even larger. But the only thing I would put a caveat on is that this is a one-time flow. From next year onwards, we are not going to get $25 billion
like one stock
every
adjustment
year.
in a
It's
sense.
just a one-time stock adjustment. From next year onwards, the flow could be 2, 3, 5 billion, but not really 25, 30 billion. So that is, fiscal arithmetic, we have to keep that consideration in mind as well.